the discussion. Okay, so what we're going to do is get into our last chapter for the auditing course, Audit 5. And throughout the first 4 chapters, we've been talking about how we're going to do our understanding outside of our reports. When we start talking about the actual audit, we're starting in Audit 3. We're going to be obtaining our understanding of the internal controls sufficient to evaluate the design, determine the controls have been implemented, make an assessment of risk and material misstatement. We make that assessment of risk and material misstatement. We then will determine the timing, extent, and nature of our further audit procedures. If we had assessed the risk and material misstatement at maximum, we would move directly to our substantive testing. If we'd assess the risk and material misstatement at less than the maximum, we would do what? We would first test the operating effectiveness, another key phrase, of the internal controls, and then determine the timing, extent, and nature of our substantive procedures. Well, throughout that, and then we sort of talked about the nature of the audit test and the testing phase in Audit 4. Throughout that, it was never contemplated that we would look at 100% of the transactions. We had determined that we would pull a sample of transactions and see if the sample was representative of the population. We would hope that it would be, and use that to make our decisions in terms of whether we are going to support a lower assessed level of control risk, and if we are able to support the amounts that are recorded in the financial statements through our substantive testing. So what we're going to do now is really take a look at what are some of the sampling procedures that we'll use, and then after that we'll get into our discussion of internal control reporting, and we'll finally get into other matters of reporting to management and those charged with governance, including getting the management representation letter from them at the end of the engagement, and we'll finally get to that. When we talk about sampling, guys, be careful. As you can see from the screen here, the term is audit sampling, not statistics. Okay, so we're not going to sit here and be calculating, the standard deviation and all that sort of stuff. We'll consider those factors, but really we want to see if you know how to apply sampling terminology to an audit engagement. So it's more of a definitional thing than anything. And then we'll talk about the internal control reporting being a major other component of this discussion. We'll get to that after the break. So with all that, let's go ahead and take a look at some potential point values here. And let's see if I can make the screen a little bigger. Okay. And so when we look at these things now, audit sampling, it tends to be about 5 points on the exam. Not a heavy area. Again, just wanting to see if you understand some key definitions. Okay. We'll talk about internal control communication. That is the heavy area for this chapter. This is an area where the examiners are expecting you to understand internal control communication, both for public companies under Sarbanes-Oxley requirements, as I'm sure you're somewhat aware of, but also if we're auditing a private company and we are asked to give an opinion on the internal control, what sort of requirements would we have there? And also just if we're auditing a non-public company, if we're asked to do some work with the internal control, or what are our responsibilities for reporting based on the work we do under our internal controls under straight normal SAS audit. We'll talk about those later. Communication with the audit committee, that's pretty light, about 2 points directly. And then management representation letter, about 5 points. And we've been referring to the management representation letter now throughout all 5 of the classes, really, or 4 of the 5 anyway. And that in Audit 2, we talked about in a review, there is a requirement to provide a representation letter. And I said at that time that the representation letter communications in a review are very similar to what we'll finally talk about here today when we are doing an audit. Okay. Class questions begin on page 61. You might want to dog-ear that or put a marker there or something so that you're able to find those pages. Okay. All right. So let's go ahead and take a look at the notion of audit sampling then. And when we talk about audit sampling, the issue is that we are looking at less than 100% of the transactions. You've seen the signs with McDonald's where they say they've served the billions and billions at this point. Well, look, you couldn't possibly, if you're auditing a McDonald's, audit every single transaction. So what would you do? You would pull a sample of transactions and draw your audit conclusions primarily about the internal control and the substantive testing, what gets recorded in the financial statements based on that sample. Now, once you start get into sampling techniques, we are faced with the possibility that the sample will not be representative of the population. So we call that sampling risk. And sampling risk is the risk that the sample will not be representative of the population. Therefore, the auditor will form a different conclusion based on the sample than they would have had they been able to look at the entire population, right? And it's very difficult to look at the entire population almost in any audit unless you're doing something very, very small, okay? But let's forget about auditing for a second. Yay, right? Okay? And let's just pretend, Andrew, like I've got a barrel full of apples up here, okay? And I'm telling you, do you like apples? Yeah. Okay, I'm telling you, I got 100 apples in this barrel, okay? And I ask you, would you like to try one? And you say, sure, right? However, I got to warn you that there's a chance that some of the apples are poison. Do you want to try an apple? And you say, what, you having that bad of a day? Okay. It's not the Sleeping Beauty poison, okay? It's the poison like from The Rock where your skin melts off before you go, right? You ever seen that movie? Okay. So it's not a pleasant experience. Okay, I don't want to talk to any, people that are on the edge. Nancy, do you want to try an apple? No. Okay, you don't want to try an apple because you're what? You're instinctively feeling sampling risk. And then what? I'll tell you what, I'll test the apples. And I'll see if they're poison, right? So I test 10 apples. None of them come back poison. I pull them, put them back in the barrel, mix them back up, and I say, would you like an apple? No. And you still say no because you are instinctively feeling now sampling risk. And then what? Even though the sample indicates, that ought to be some entertainment. Even though the sample indicates, that'll wake me up, right? Even though the sample indicates that there's no poison, there's a chance that there could be some poison apples still in that population, right? So you say, no, I'm not eating any of those apples, right? Well, auditors have to live with a certain amount of that risk, that based on the sample, they'll determine that either the control has operating effectiveness and or what? The account balance is not materially misstated based on the sample when in fact it is materially misstated, right? And we just have to live with that. The beauty of audit sampling is it allows us to quantify how much risk we're taking. So at least we know if we're taking a 1% chance, a 5% chance, a 50% chance, we can, unless we're dealing with some really weird population, pretty much confidently do what? Quantify how much risk we are taking, okay? So that's where we're going with this. And you take a look at the next page, and we start talking about that when we're looking at our audit, our using sampling for our audit, that either statistical or non-statistical sampling is okay. So you don't have to necessarily use statistical sampling. You could use non-statistical sampling. The other issue is that audit sampling is not a substitute for audit judgment. Flashcard that. The examiners love to try to trick you into giving your judgment up to something, right? Remember we had the issue of internal auditors and they were saying it's okay to share your judgments with the internal auditors. We said what? No, we can't do that, right? Now they're going to try to get you to think that you could sacrifice or give up your judgment to the sampling gods, to the statistical gods. No, nothing is a substitute for the auditor's judgment, right? So flashcard that. Okay. Now, when we use sampling techniques, we are to use random sampling. Okay, so coming all the way down, we are to use random sampling methods. Okay, there are other types of sampling methods that would be appropriate for other type of applications, such as if we were doing sampling for the census, we would use something called block sampling, where we go through block by block and see what we get as a result of our sampling and use that to project the population. But that makes sense when you're doing a census, right? For audits, we do not use block sampling. We use what? We use random sampling, okay? Okay, good. So you come over and you take a look at the next page, and we talk about, now I think this flipped too fast on me. We talk about, no it didn't. Next page, please. Okay. And I want you to come over and take a look at the type of sampling. Yeah, okay, we're on the right page now. And we have what? We have attribute sampling. We use attribute sampling when we are talking about the testing of the internal controls. When we talk about attribute sampling, we are looking to see if a transaction contains a certain attribute. For example, if we're sampling time cards, the attribute we are looking for is the signature of the supervisor, right? So an attribute is something that the item contains, right? If it contains a signature or not, we call that attribute sampling. We will also talk about variables sampling, and we're going to use that for our substantive testing, okay, of our account balances. But towards the end of our discussion this afternoon, before the break, talking about sampling here, we will also talk about PPS sampling. That's probability proportionate to size. This is the state-of-art sampling technique that is really used more predominantly in practice, and we'll talk about that towards the end. But again, that is also used for what? For our substantive testing. So attribute sampling for our tested controls, and then when we get into our substantive testing, we'll talk about two different sampling plans, variables versus PPS. Okay. Now, of course, you remember the concept of audit risk, right? Okay. So when we talk about audit risk, how do we define audit risk? Audit risk is determined how? Audit risk equals what? It's the RMM, right, times the DR. I mean, you guys should be like, humming that in your sleep. I mean, while you're sleeping, you should be going, internal risk times control risk equals risk of material misstatement. Audit risk equals inherent risk times control risk times intentional risk. Right? And that's what you should be doing at night, okay? So what happens? We sit here, because you got to know that. I mean, that is clearly 10 points on the exam. And so we know that our what? Our risk of material misstatement is IR times CR. Good. Okay. And then, of course, we would put that times the DR, right? Now, they tell us that when we sit here and we have our audit risk, there are uncertainties due to audit sampling, and then there are uncertainties due to factors other than audit sampling. Okay, and I just want you to put next to that C page 7. Okay, just put C page 7 next to that, and we'll get to those specific things when we get to page 7. Okay, so don't worry about those right now. But let's talk about uncertainties due to sampling. Okay, and that comes up when we're dealing with our CR times our DR, because we're going to be using sampling for our control testing, and we're going to be using sampling for our substantive testing, aren't we? So when we talk about there being a potential for sampling risk relating to audit risk, we're really talking about factors related to our control risk and our detection risk, aren't we? Okay. So you come over and you take a look at the next slide, next page, and that's indeed what we start talking about over here. We talk about the risk of incorrect acceptance for our substantive testing, the risk of incorrect rejection, and then for our control testing, right, IR and CR, we're going to be getting into what? The risk of assessing control risk too low and the risk of assessing control risk too high. So those are really affecting our two components of audit risk that we just emphasized on the previous page, DR and what? CR, right? Okay, so let's understand what these are all about, and let's take a look at first the risk of incorrect acceptance. The risk of incorrect acceptance is the risk that the auditor will determine based on the sample that there is not a material misstatement in the account balance, transaction, the disclosure, the overall financial statements, when in fact, if the auditor had looked at 100% of the transactions, they would have found the material misstatement, right? Risk of incorrect acceptance. We incorrectly determined the financial statements were not materially misstated when in fact they were. This is a bad situation. This is audit failure, isn't it? This is what? You're going to give an unmodified opinion when in fact you probably should have qualified or maybe adversed or something, right? Okay? Now you come over and we look at the risk of incorrect rejection. What is this? This is the risk that the auditor will determine based on the sample that the account balance has a material misstatement, or the transaction has a material misstatement, or the disclosure has a material misstatement, when in fact, if the auditor had looked at every single transaction, they would have determined what? That there was not a material misstatement. So the auditor incorrectly rejected the financial statements, right? Okay. Now, when we get to the factors for our control risk, we look at the risk of assessing control risk too low or the risk of assessing control risk too high, right? Now what happens? The risk of assessing control risk too low is the risk that based on the sample, the auditor will determine that the financial statements are not materially misstated. That's for my substantive testing. Restate that. The risk of what? Assessing control risk too low is the risk that based on the sample, the auditor will determine that the control has operating effectiveness, when in fact, if the auditor had looked at every single transaction, they would have found that the control does not have operating effectiveness. Okay? For example, the auditor looks at a sample of time cards. And based on the sample of time cards, the auditor determines that the supervisor signed off on the time cards a sufficient number of times, right? We pulled 100 time cards. We looked at them, and we only found 2 where the supervisor didn't sign off. If we had looked at, say, all 10,000 time cards, which clearly we can't do, right? We can't be there forever looking at all 10,000 time cards. Is there a question as to what page we're on or something? So right now we are on page 6, okay? It's always up there on the screen, okay? All right, so we're all back on track now, okay? All right, so what happens? If we're sitting there and we're in a situation where we looked at the time cards 100 and we saw that 3 or 4 of them weren't signed or whatever, we say, okay, this control has operating effectiveness, right? When in fact, if we had sat there and looked at all 10,000 time cards, we would have found, I'm going to pick some outrageous number, 8,000 of them weren't signed or something, right? The sample deceived us, didn't it? It made us think that the control had operating effectiveness, when if we had looked at all the time cards, we would have found what? That it did not have operating effectiveness, okay? Risk of assessing control risk too high is the risk that based on the sample will determine that the control does not have operating effectiveness, when if we had looked at every single transaction, we would have found, no, the control does have operating effectiveness. For example, look at 100 time cards. You find 20 of them that aren't signed. You look at those 20 time cards and you say, well, gee, out of 100, 20 not being signed, that's way too high. This control does not have operating effectiveness. When if you had looked at all 10,000, you would have found that that was the only 20 that weren't signed out of 10,000. You probably could have supported the lower assessed level control risk that the control had operating effectiveness. Okay? Now, let me ask you something. Are these mistakes that are made by the auditor? Did the auditor make mistakes here? Okay, what part of the word incorrect do you not understand? If the auditor did something incorrectly, that's a mistake, isn't it? Right? If the auditor did something incorrectly, isn't that a mistake? Okay, so these are mistakes that are made by the auditor based on the sample. Hey, we can't look at all 100% of the transactions, but what? We had to pull a sample, and the sample lied to us, didn't they? Is eating a poison apple a mistake? Why do you have to think about that? Is eating a poison apple a mistake? Okay, eating a poison apple is a mistake, and it's a mistake that you could make based on what? Based on the sample, right? You sit there and say, hey, the sample came back out of 10 apples, everything was okay. I reached in the barrel, I got killed, right? So you made a mistake, didn't you? Okay, so you can make a mistake. You can incorrectly accept or reject the account balance based on the sample. It's a mistake, isn't it? Right? Is assessing control risk too high or too low a mistake? Yes, it is. TOO means you went too high, you went too low, didn't you? You went too high, you went too low. Why? Not because you were derelict, but because we can't look at 100% of the transactions, and what? The sample indicated that the control had operating effectiveness, when in fact it did not. So we made the incorrect decision based on the sample, right? Okay. All right, guys. Now, if you continuously, have to say something to your neighbor throughout the class, throughout the discussion, I'm going to at some point assume that that person doesn't want to hear everything that you're saying. So, save it for the break, save it for after. After today, you don't have to listen to another one of my lectures ever again. Okay, so hang in there with it for 4 hours, and then you can say all the horrible things about me you want after that. Okay, all right. So let's just go ahead and let's take a look at this notion of efficiency. Okay, and what happens. Okay, when we talk about efficiency, if the auditor has assessed control risk too high or suffered the risk of incorrect rejection, this audit is not going to be efficient. How come? You assess control risk too high, don't you, based on the sample? So you're going to alter the timing, extent, and nature of substantive procedure. What nature? You're going to want to use external evidence when you could have used what? Internal evidence. So you're going to have to chase confirmations all over town to try to get the people to respond to it. Extent, you're going to take larger sample sizes for your substantive testing. Timing, you're going to do what? Year-end testing instead of interim. So you're going towards those inefficient end of the spectrum there, when in fact, if the sample hadn't lied to you, you could have used external evidence instead of internal evidence. You could have used smaller sample sizes for your substantive testing. You could have done some interim testing instead of year-end testing purely, right? Okay, so that's an example of how we are inefficient because of our assessing control was too high. How about the risk of incorrect rejection? With the risk of incorrect rejection is going to happen based on the sample, we're going to determine, account balance is materially misstated. So what are we going to do? If we think an account balance is materially misstated, how would you respond to that? How would you respond to that? How would you respond to an account balance being materially misstated? Huh? Okay, you're going to go straight to the board of directors as soon as you think there's a material misstatement in the financial statements? You're going to go to management as soon as you think there's a material misstatement in the financial statements? You're going to immediately run into the CEO's office? Okay, what are you going to do? Huh? You're going to make sure, right, before you're going in and telling somebody that their kid's ugly, right? Because as far as the CFO's concerned, that's their kid, isn't it? And now you just said, hey, your kid's got to, we're going to have to put braces on this kid, right? It reminds me of a Rodney Dangerfield joke that these two parents that aren't too attractive walk in to have pictures taken of their kid, and he's the photographer. You guys ever heard of Rodney Dangerfield? He's this comedian that I get no respect. Oh, everything's bad. Like, for example, the doctor told me I have to lose weight. I said, do you mind if I get a second opinion? He said, okay, you're ugly too. Okay, these are the kind of jokes he would tell. So anyway, so what happens? He tells this one where the parents walk in. It's in a movie. The parents walk in, and they're getting pictures taken of their kid, and they're all excited, and the parents aren't too attractive. And they say, oh, he's got your eyes. And then the father says, oh, he's got your nose. And then Rodney Dangerfield says, he's got my sympathy. Okay, but anyway, so what happens? So, you're telling the kid, the parents, that their kid is ugly if you tell the CFO the financial statement. And people don't like you to tell them their kid's ugly. CFOs, management don't want to hear that their financial statements have a material misstatement. So you're probably going to check for sure, like you say, verify, pull a larger sample for your substantive testing so you can really get a handle on what's going on and the adjustment you would like. And what will you determine? Oops, there's not a material misstatement, right, as you look more closely. So you will what? Come to the right decision, but in a very inefficient manner because you pulled what? I don't know, very inefficient, but somewhat efficient manner because you pulled a larger sample, right? Same thing with assessing the control risk too high. You'll come to the right conclusion because you'll open up your substantive testing, nature, extent, timing, but what? You will come to the right conclusion, right? Okay? That is different than what happens to you when you go over to the next page when we talk about effectiveness. And if we have suffered the risk of assessing control risk too low or the risk of incorrect acceptance, our audit is not effective. What happens? We assess control risk too low. So, nature, extent, and timing of our substantive procedures. We'll use internal evidence instead of external evidence. We'll take smaller sample sizes. We'll do interim testing when we should have done what? Year-end testing, enough year-end testing. And we will find, and we are now what? Risking that we'll miss that material misstatement, right? Because we didn't do enough substantive testing, the appropriate substantive testing. And the risk of incorrect acceptance is by definition audit failure, isn't it? We give a what? We give an unmodified opinion when we should have qualified. Okay? All right, so you come over and you take a look at this table. Notice we went through a lot of definitions there, and I didn't ask you for a flashcard. Okay? And the reason being that I'm saving your flashcard for right here. Okay, so all you need to do is take this page to your copy machine, shrink it down so it's flashcard size, and turn this into a flashcard. And we have one for substantive testing. We have one for what? For our control testing here. 2 flashcards. Okay, and so what happens? You take a look at this, and we have our substantive testing, and they tell us what the sample indicates, that the population's okay or it's not okay, and then they tell me the true recorded value of the population. Do auditors ever know the true recorded value of a population? We never know for sure. The true, not recorded value, but the true what? The correct value of the population. We never know for sure. Only God knows this, right? But the CPA exam is God to us, and they're telling us this is the true condition of the population, right? Okay, so this is the true condition of the population. The CPA exam is telling that. The sample indicates the population's okay, and it is okay. That's a correct decision, isn't it? But if the sample indicates the population is okay when it's not okay, that's an incorrect decision. That is the risk of incorrect acceptance. Haven't we suffered the risk of incorrect acceptance? Sample indicates that the population is okay, it's not okay. That's risk of incorrect acceptance. Our audit is not going to be effective, right? Okay. Okay, good. Then you come over, sample indicates the population's not okay when it is not okay. That's a correct decision. Sample indicates the population's not okay when it is okay. That's the risk of incorrect rejection. Our audit is not going to be efficient, right? Right? Okay. Okay, good. You come over to the next one, okay? And the sample indicates that the population's okay, and it is okay. That's a correct decision. Sample indicates that the population is okay when it's not okay for our internal control testing. That's the risk of assessing control risk too high. Our audit is not going to be efficient, right? We will still come to the correct conclusion, but in an inefficient manner, right? Sample indicates that the population is not okay and it's not okay. That's a correct decision. Sample indicates the population is not okay when it is okay. That's the risk of assessing control risk too high. Our audit is not going to be efficient, right? Isn't that everything we just said on the last couple pages? Okay, so you need to flashcard this 2 tables, and that sort of goes through how you would think about all the different things that we just talked about on that page and a half or so of information. Now, don't do this. Don't do this to your book. Don't do this to your book. I'm just doing this. Sometimes anything I do, you guys will think, oh, he wanted us to scratch that out. There must have been something wrong with it. Don't do that, okay? I'm just going to go ahead and I'm going to put some Roman numbers in these quadrants. Oops, that would be 3. I was absent the day they talked about Roman numbers in the 4th grade. Okay, something like that. Why did they get rid of the Roman number system? It's highly inefficient. I mean, how are we going to do with this I times I divided by I take the square root of I. I mean, there's all kinds of things you can't do very well with the Roman numeral system. You turn to the Arabic system, now we're jamming, aren't we? Okay, so anyway, so I'm not too fond of the Roman numbers, unless we're talking about what? The Super Bowl, I'm okay with it, right? I can. But even after a couple of beers, that doesn't make any sense to me. Okay, all right, so anyway, so what happens? We go ahead with this, and you'll see a question in your homework in which they'll ask you, what's happening in quadrant 2? Hello? Hello, this thing working? What's happening in quadrant 2? We have the risk of incorrect acceptance. Good, because what? The sample indicates that the population is okay when it in fact what? Is not okay. We incorrectly accepted that population. We have the risk of incorrect acceptance. Our audit is not going to be effective. Good. Okay. All right. Nice. So you need to be able to figure it out like that, because that's where you'll see some questions in your homework. By the way, in your homework, there's something like, I want to say 43 questions or so. I just don't want you to strike those out. There's something like 43 questions or so that deal with audit sampling, okay, multiple choice questions. And the first like 5 or 6 of them are really, really hard questions. In fact, almost like just pick C and move on if you get that question on the exam type questions, okay? You know that you should never linger more than what? Maybe 3 minutes on any one question like we talked about, okay? And if you start to get past 3 minutes, then just move on to the next question, okay? But for those questions, skip those first, because they're really hard questions, and we put them like as the first 6, 7 questions. And I feel that I can just picture my students on Sunday morning getting up to do your homework and then saying, oh no, forget it, I'm going back to bed, I can't handle this, okay? So skip past those 6, and once you see that those questions have gone away, and it's about a partner that was trying to explain something to you, and they put together a table like this. If you ever have a partner that tries to explain things to you like that, just quit, because you're not going to understand anything this guy says. So go past those 6 first ones, and then you'll get into some that are more common to what you'll see on the exam. Work through those, then come back and work those 6, and I think you'll get more better feeling, positive feelings out of working your homework, okay? All right, now as we said on page 7, there's also discussion in here of items that are that add to our audit risk that don't have to do anything to do with sampling. And for example, we select the incorrect procedure for the particular account balance. The mistake is right there in front of us. We don't catch it. We're being deceived by what? Collusion, concealment aspects of fraud. These don't have anything to do with sampling, right? Okay, these just sort of have to do with the, if you will, the human condition, right? Okay, that we're going to just make mistakes and people are going to lie to us and that kind of stuff, right? Okay, so those are non-sampling risks. Okay, good. Come over and let's take a look here at our using of attribute sampling for our test of controls. Okay, and we've got a couple of concepts now. Now we're getting into sort of more of the definitional stage here, starting with tolerable deviation rate. Okay, now what I want you to put down here is planned. This is something that is planned, and I'm going to put parentheses on it because I don't want you to call it the planned tolerable deviation rate, because we just call it what? Deviation, tolerable deviation rate. And if you say plan, people think you don't know what they don't know what you're talking about. So you say what? Tolerable deviation rate. But it is something that is planned by the auditor at the beginning of the audit. Is that when we do planning? Or not at the very beginning, but near the beginning of the audit, before we actually start moving into our testing phase. Okay? And so what happens? Let's say the auditor looks at 100 time cards and says that they will tolerate 3 out of 100 time cards not being signed. What's my tolerable deviation rate? 3%. Good. The tolerable deviation rate, the TDR, is going to be 3%. That means that the auditor will be happy if there's what? 0 time cards that aren't signed, 1 time card that's not signed, 2, 3, not 4, right? If we get to that 4th one, now we have exceeded our tolerable deviation rate. We're going to determine that this control does not have operating effectiveness, and we will likely do what? Expand the nature, extent, and timing of our substantive procedures, right? Okay, that's tolerable deviation rate. Now, in assessing the tolerable deviation rate, the auditor needs to consider that as you get up close to that 3%, there could be undetected deviations, and so there's a chance that there will be a deviation in there. And the auditor should also consider that the deviation rate from the prescribed control will be higher than the actual level of misstatement. What does that mean? Just because the supervisor didn't sign the time card doesn't mean that the employee put down the wrong number of hours. In fact, the employees will usually put down the correct number of hours, even if the supervisor doesn't look at the card, right? So the actual misstatement rate will always be less than, not always, but generally be less than what? Than the deviation rate from the control. Okay? So you can see that, and you can put down CPA, and that's in your homework, 02611. Do you want to look at that one? I'll take that as a no. Okay? All right, so you come over and you take a look at deviation rate versus tolerable rate. Now, we've already determined that the tolerable rate is a planned number. And we just call it deviation rate. We don't put the word actual in front of it, but that's what it is. It's the actual. So the tolerable deviation rate is what? The planned. Meanwhile, the deviation rate is the actual. Okay, so what happens? When we came out with our tolerable deviation rate and we said we were going to look at 100 time cards, how many had we actually looked at that point? None. We hadn't looked at any yet, right? But we came up with that tolerable deviation rate was. And then what? Then we actually pulled the 100 time cards, and we looked and we found 2 that weren't signed. So the deviation rate equals what? Not a trick question. 2%. Is this the happy auditor or the sad auditor? This is a happy auditor because what? I was willing to take up to 3. I could have taken 1 more and still been happy, right? But I'm definitely happy at 2. Okay? Okay, good. Now what? Let's say the auditor, and I think you know where I'm going with this, pulls the time cards, looks at them, finds 6 that aren't signed. Happy auditor or sad auditor? Now the auditor is sad because he's saying, hey, I was willing to take 3. At 4, I wasn't happy anymore, right? And I found 6, okay? So what happens? Now this auditor is sad unless they have a fetish for what? For substantive testing, because that's where they're heading, right? Nature, extent, timing. They're going to have to use external evidence instead of internal evidence. So you're going to have to take larger sample sizes for their substantive testing. We're going to have to do more year-end testing, right? Okay? Okay, good. So we come over. And this example that we have down here is one of the more excellent examples I've seen. This has been in the book for a long, long time. And sometimes people, well, why don't you change that? Why don't you update that? Because it doesn't need updating, and it's beautiful. Okay, it's a really, really good example. So what I want you to do is, and I'm not saying that because I had any involvement in it. This might have been the way it was talked about when I took the course, okay? So it's been here for a long, long time. And so it's a very, very good, at least 20 years since I've been teaching. I know it's been there. So this is a good example for you to read through carefully again, okay? Usually I don't tell you to read the book, but for this one I think you get a lot of value out of going back through the discussion, okay? So let's just go through, and in this example, the auditor wants to determine the percentage of sales orders that are missing credit approval. So what happened? We have a sales order. Here's the sales order. And there's supposed to be credit approval, isn't there? On that, if we gave the person credit, there should be some sort of stamp or something that says approved by the credit department, or a file somewhere that we can look up, internet-based system that shows that the credit approval box was checked off or whatever, right? Okay, now what happens? Let's say there is a credit approval box. The auditor is looking to see if there's any that aren't checked. Is there any that aren't checked? Because if that's the case, that means they did not get credit approval before they offered this customer credit, right? And if we don't offer a customer credit, there's a chance that we're not going to get paid. If we offer them credit, we don't check their credit first, there's a chance we're not going to get paid, right? Okay, so let me ask you this. Why does the auditor care? Why should the auditor care if the client gets credit approval before we issue credit? Yes?
Because then if there's a higher case that there might be problems with their receivables.
There's a higher chance that there could be a misstatement when you say problem? Okay, and so if there's a higher chance that there'll be a misstatement, what would we learn from having the credit approval? What would we learn from understanding that the control of getting the credit approval has operating effectiveness? What would that do for us?
So we're identifying ones that's actually good, have a good credit.
That their clients, customers have good credit, and we know that our client is what? Putting that internal control into operating effectiveness, right?
Yes.
And so the risk of material misstatement is coming down,
Yes.
so we can plan our substantive testing,
Yes.
right? Okay. What assertion then? If I'm doing an audit procedure, it's because I'm thinking it's helping me with an assertion, right? Is that why we do audit procedures? So what assertion is being assisted by this?
Doubtful allowance may be understated and accounts receivable may be overstated on the financial statement.
Existence occurrence is what I hear you saying, and completeness.
Kind of, yeah.
Well, I asked for assertions, and if I can't tie any of what you just said back to an assertion, then you didn't answer my question. What assertion is being? Huh? The valuation assertion is being assisted by what? The fact that if our client has good credit approval, then the chance that someone's not going to be able to pay has been what? Has been reduced. So I'm more confident that the valuation assertion will not be misstated in the financial statements, right? Okay, so it's helping with valuation. I disagree that it helps you with the existence occurrence, because the person could have great credit today and they're out there and they still owe us the money, but their ability, I mean, the person could have horrible credit, I should say. They're still out there and they still owe us, but they're not going to be able to pay us because their history indicates that they can't pay us, right? So that control is protecting what? Is protecting against misstatement in the valuation assertion, right? Okay, now the reason I point that out is you always have to know at some level what assertion, not at some level, at a complete level, you have to know what assertion you're doing your audit procedure for. And if you don't know the assertion, you're not doing your job. And I don't mean from the standpoint of the CPA exam. If you're actually in practice and you're going through a procedure and you're not thinking about the assertion, then you're going to miss the misstatement or miss the problem with the control, right? Okay. Okay, good. So I see my friend Tim Lanigan is here. And let's take a look now. And we're sitting here and we're looking for those that don't have the credit approval. Okay? And so that's what we're looking for. Now we come down and we say that the universe is going to be all of the sales orders that were used during the year. So look for all the sale orders that were used during the year. And then take a look, and each sales order is considered a sampling unit. Okay, so our universe is everyone that was used, and what? Each unit, each sales order is our sampling unit. Now we come over to the next page, and we say that if we're dealing with a missing credit approval, okay, a missing credit approval, that is considered a deviation. Okay, missing credit approval flashcard is considered a deviation if we can't look at it to see if it has the credit approval. Then we should go ahead and we should consider that a deviation from the control. Now, when we talk over here about sample size, and you come down and we say that there is an inverse relationship between sample size and some of these items, not all of them. There's not an inverse relationship between all of them. But we need to know how these different factors affect sample size. Okay, so we first start with the risk of assessing control risk too low. And we say that there's an inverse relationship between the risk of assessing control risk too low and sample size. Okay, flashcard that. But let's go back to the apples. So Nancy, how much have we tested? 10 of them?
Yep.
And they all came back no poison, and you still said no, right, to having one? Right? Okay. I'm going to test 20 apples now.
How many are in the thing?
100 in the barrel. Can someone do something about that? How many?
How many are in the, you said you're gonna say 20 for 100?
Yeah.
Okay. Still not in your apple.
Okay. 30. I'll test 30 out of 100.
Nope.
40 out of 100.
No.
Okay. 98 out of 100.
How much do I value my life?
I can't answer that for you. Only you can answer that. What's happening? No sample size is what? Is big enough for us in this situation. We can't accept any risk, right? Okay? But what? The auditor has to accept some amount of risk. And the lower we want to get that risk, the bigger the sample size, right? Okay, so inverse relationship between the risk of assessing control risk too low, making that mistake, and sample size. The lower we want to get the risk that will make the mistake of assessing control risk too low, the bigger the sample size has to be, right? Okay, okay, good. Now we come over and we talk about expected tolerable deviation rate. I don't know why I keep trying to skip one. Tolerable deviation rate, and we say that there's an inverse relationship there as well. Flashcard that. Okay, now when you look at this one, it gets a little bit confusing. It's not as intuitive as the other one, right? But what happens? If I'm sitting there and I'm looking at my controls, and you don't have to write this down, guys, because this is not in standard. This is just where I've seen some guidance, okay? And they tell us that if your tolerable deviation rate is 0 to 3%, that means that your assessment of the control risk should have been low. If your assessment of control risk is at medium, then maybe you can take a what? Tolerable deviation rate of say 4 to 7%. And again, the reason I'm not asking you to write this down, the standards don't come out and tell us this. This is just some guidance I've seen. Connection between tolerable deviation rate for your sampling, for your controls, and your control risk. And if you assess your control risk at maximum, then you're saying that your tolerable deviation rate has probably gone to what? 8%, greater than 8%. Okay? Now, what happens? If you're sitting there and you're saying that your tolerable deviation rate is that your control risk is low, your tolerable deviation rate is 0 to 3, you're going to take a larger sample for your control test, aren't you? And you're doing that because you want to make sure that that control is actually operating. You must think this is a very important control and you're assessing it at low and you want to make sure that this control is working correctly, right? So you're going to take a larger sample size for your control testing. And remember, we had our control tests and we had that pyramid where reperformance was at the top and what? Inquiry was at the bottom. So you're probably doing what? You're probably doing more reperformance, less inquiry, and you're also doing what? Larger sample sizes, which we're talking about here, for your control testing, aren't you? Okay. If you're sitting there and you have assessed your control risk at medium, now you're saying, well, a medium control risk, I'm not as fond of that control, am I? So I'm willing to accept less use of that control, more deviations from that control, and so I don't have to pull as big of a sample size because that control is not nearly as important to me, right? Because I've assessed the control risk at medium, and I can maybe get to more observation, a little less reperformance, maybe a little more inquiry there, right? Because it's not only the number of items you look at, it's the type of test, right? What is my sample size for my control testing if I assess my control risk at the maximum? Sample size for your control test, testing of operating effectiveness when you assess control risk at the maximum. When you assess control risk at the maximum, you take a large sample for your control testing? How small? How much control testing do you do when you've assessed your control risk at the maximum? You go straight to substantive testing. That's my point. Your what? Your sample is 0, isn't it? It's as small as it can be. Okay, so the higher your deviation rate, tolerable deviation rate from a control, the less important you've deemed that control to be. And when we get to all the way in the 8 to 10% for the tolerable deviation rate, you've determined, well, who cares if they use that control? It's a lousy control, right? So your sample size for your testing of operating effectiveness will be 0, right? Okay, and go straight to substantive testing. Inverse relationship, right, between my tolerable deviation rate and my sample size for control testing. There is a direct relationship between sample size and your expected deviation rate, flashcard that. Okay? So if you have a client that year after year messes up the internal control, and you walk in one year and they say, "Good news, we fired everybody that didn't know how to do the control, and we have a whole new staff that knows how to do the control," what are you going to do? Take a what? Big sample size to see if indeed they're doing what they say they're doing, because your expectation is that they still don't get it, right? Based on past experience with that client, whatever, right? What happens in year two? You look at year one, everything seems okay. What happens in year two? Year two, I'd probably stick with the same size, okay, just to make sure that it wasn't, that one year where they beat everybody up out, and after we said it was okay, they went back to their bad habits, right? Maybe by the third year, I'm sitting there saying, okay, they got it. Now I can take a little smaller sample size because my expected deviation rate has come down based on what? Based on past experience with the client, okay? So that's the logic behind those guys, but you got to know, you got to flashcard how sample sizes affects these. Now, population for large populations is usually not going to affect the sample size, so you can just go ahead and flashcard that for items where there's over 5,000 items in the population. If it is amount that is less than 5,000 items in the population, then they have a different table that you'll use to determine your sample size. We're going to look at some tables here in a minute, and those for determining sample size, and those tables are right out of the AICPA's sampling guide, okay? And if you look at that same guide where we pulled these large population sample sizes from, they have another table for smaller sample sizes. But for those that are less than those that are greater than 5,000, I should say, there's really no effect on sample size once you get over that number of items in the population. Okay? All right, so let's just go ahead and let's take a look here. And they're giving us some of these parameters up here, and we're going to look to this table on the next page. Yes, Ryan?
Are we gonna have to memorize the table for this test?
No. No. No, they don't get that crazy on you. The table that's coming up on the next page, you mean?
Yeah.
Yeah, no, they won't do that to you, but you are going to have to know how to read it. Okay, but yeah, you don't have to memorize it. Yeah, now that would be awful. I think they only do that to, like, nuclear scientists or something, make them memorize like a periodic table or something. It's nothing like that. Okay, so whatever. I probably messed up probably just put two sciences together that don't belong together, but whatever. Okay, so what happens? We sit here and we take a look, and we are coming up with these parameters, and Ryan, we're going to use a sample on the next page to determine the sample size from these parameters, and we say that the auditor is willing to accept a 5% risk of assessing control risk too low. If I'm going to accept a 95% risk of getting the wrong answer, how confident am I that I'm getting the right answer? I'm willing to accept a 5% chance that I get the wrong answer. 5% risk of assessing control risk too low, right? So how confident am I that I'm giving the right answer? I'm 95%. And you notice I emphasized the word confidence, right? If you want to get your confidence level, you take 1 minus the risk, not minus 94. You don't want to be 5% sure of anything in life, right? Okay, I'm 5% sure my mother loves me, right? That's not good. Okay, so what happens? 1% minus 5%, that's 95%. Confident? That says 95% confident. That means I'm 95% confident, right? So 5% risk of assessing control risk too low. We are expecting a deviation rate of 1%. Not bad. That's a pretty decent client. They're usually pretty good, I guess. And then what? The tolerable deviation rate is up around 6%. Now, again, the standards don't call out and say 6%. That means medium. I'm saying, okay, you're probably at a medium assessed level of control risk, right? If you want to go to low, that tolerable deviation rate is going to come down, the sample size is going to go up, right? Again, the standards don't tell you what tolerable deviation rate equates to your assessment of control risk. I'm just saying some things I've read before. So we go ahead and we're going to determine the sample size from table 1. So go over to table 1, and Ryan, you don't have to memorize this, but please do not write on this table, and I don't mean the table here in the class. I mean the table that is here, because I think it'll help you to leave it clean, so when you go back to this example, you can kind of figure it out. It takes all the fun out of it if you've circled the answer already, right? Okay. So when you look at this table, they tell me this is the 5% risk of assessing control risk too low table. Be careful, guys. We could call this the 95% confidence level table. When I say we, I mean the examiner. Okay. So make sure that you understand how the risk of assessing control risk too low and the confidence level relate to each other. And then they told us that it was what was the expected deviation rate? 1%, and they told us that the tolerable deviation rate was what? 6%. So our sample size is 78, isn't it? Now you can write on the table if you want to, but I think you would learn more by not when you go back over this. But again, you come over and you can write the answer in back where they asked it. So the sample size is what, 78? Write the answer in, but I don't think you should write on the table. Okay? Okay, good. So then they say what would happen if the expected deviation rate was actually 0 instead of 1. Would the sample size increase or decrease? Good. The sample size is going to decrease because what? We have a direct relationship. Expected deviation rate comes down. Sample size should come down. And this means I think my client's pretty good at implementing this control, right? Okay, so you come over and you take a look at the table. Let's just confirm this with the table. And again, I don't think you should write on the table, but we were at 1 before. Now we're at 0, aren't we? Right? And if we're sitting here and we're still at the 6%, it sure did decrease to 49, didn't it? Okay? Okay, good. So come back to the previous page, and let's go ahead and let's write in then, what, 49? It'll decrease to what? Might as well put in the number. It'll decrease to 49. Okay, good. Then we come down and we said would the sample size increase or decrease if the tolerable deviation rate increase. So now we're saying we're willing to accept more deviation from this control. It's a what? Inverse relationship, right? Inverse relationship. So what's going to happen? Our sample size is going to decrease, right? Because we're sitting there and we're saying, okay, we don't think this control is nearly as important, so we don't need as big of a sample size, right? I don't know about nearly as important, but it's not as important if we're willing to accept more deviation from it, right? We're willing to tolerate more deviation from it. So let's go ahead, let's confirm with the table. We come back to the table, and where were we? We were at, I'm going to erase these, don't really help me at all here. We were at what? We were sitting here at 78 before, weren't we? And we just went to what? 7. No, we're still at, I'm assuming now that we're still at the 1% expected deviation rate where we were for the first one. And it went to 66, didn't it? Assuming we're still at the 1%. Okay, good. So you go back for the expected deviation rate. You go back and you can write in now 66, right? Right? Okay. Okay, now let me ask you this then. If that's the case, if we're sitting there and we are now in a situation where we are at the 10% risk of assessing control risk too low, this is saying I'm only willing to be 90% confident in my decision, right? So do we need a larger sample size or a smaller sample size for that? Smaller sample size, right? Smaller sample size? So the sample is going to decrease the sample size. Now, I can't go to the table to confirm that, but I can promise you that if you were to go to the AICPA's auditing sampling guide where we got this table from, all the numbers are smaller on that table. Every single number is smaller on that table, right? The 90%? Okay. Okay, good. So we go ahead and we select the sample. And when we look, we're going to use what type of sampling? When we select the sample, random sampling. Now we're going to evaluate the sample, and we're going to evaluate the sample from table 2 on the next page. And we'll go over there in a minute. And when we go to that table 2, what we're trying to determine is what is the upper deviation rate. And the upper deviation rate is going to be the deviation rate that we find in the sample plus something called the allowance for sampling risk. Okay, so you come over and you take a look, and they tell us that when you're looking up the results for your upper deviation rate from table 2, make sure you are also evaluating your sample on the 5% table in our example. So if you determine your sample size from the 5%, you have to evaluate your sample on the 5%. On the exam, they may tell you your sample size is this, your risk of assessing control risk was 5%, and then they give you the tables to evaluate, and maybe they give you a 10% table and a 5% table. You need to know to evaluate what? On the 5% table, right? Okay, then what? Then we come over and they say locate the sample size and the number of deviations. That intersection is the upper deviation rate. Okay, and they tell us again that the upper deviation rate now is going to be the sum of the deviation rate in the sample plus this allowance for sampling risk. Okay, now I'm going to come back to this and look at this formula again after we look at the numeric example, and I think it'll make more sense when you look at the numeric example on the next page. So just come over to the next page, and they now give us some information about our sample, looking at the credit approval. And guys, this gets a little confusing because we said the sample size was 78, and now we're saying forget all that, the sample size is 100. Okay, so just forget that part where we determined that the sample size was 78. They're simply telling us now that the sample size is what? 100 items. Okay, and we go ahead and they tell us to calculate the sample deviation rate. And when we calculate the sample deviation rate, it's 1 divided by, what was our sample size? 100, so it's 1%, isn't it? Okay. Then what happens? Then we say determine from the table now the upper deviation rate. And when they say the table, they mean this table right here. Now look, in this example, they only gave me one table. On the exam, they could sit there and give me what? Give me a couple different tables, 1% table, 10% table, 5% table. I need to go to the 5% table if that's where I pulled my sample size from, right? Okay, so I come over and I had how many? What was my sample size, I should say? 100, and I had how many errors? 1 error. Okay, now you're looking at that and you're saying, well, if I only had 1 error, isn't my deviation rate 1%? And it is, but remember, you're still looking at a sample, aren't you? And there's always a chance that the sample will be different from what the population says, right? I mean, what the population exists, the sample will be different from the true condition of the population, right? Okay, so what happens? We do this in statistics all the time. If you watch TV for 10 minutes these days, you can't help but hear about the most recent poll between Clinton and Trump and plus or minus. And they always say plus or minus 3% on those polls. That's saying that what? There's a range around which these results can hover, right? Okay, now what happens? They give you the lower end and the higher end of that range. For auditors, we only care about what? The upper end of the range for this test, because we're looking to make sure that what? The upper deviation rate does not exceed our tolerable rate, right? So we don't worry about the plus or minus. We just worry about what? The plus end of this. How high can this go? And they're telling us that this could go as high as 4.7%. So what's happening? Our upper deviation rate is 4.7%. And if they're telling us that the allowance for sampling risk, they're asking us, what is the allowance for sampling risk? That's going to be what? Upper deviation rate of 4.7% minus 1%, the deviation rate we saw in the sample. We have a cushion here of 3.7%, don't we? Don't we have a cushion there? Saying, auditor, I know the sample told you 1%, but can you live with the fact that there's a chance that this could be what? As high as 4.7%. Can you live with that? right? And so how do we know if we can live with it? Well, before we do that, let's look at the conclusion that's formed here. The conclusion is that the auditor is what percent sure am I? Good. The auditor is 95% sure. Good. I had a student that wanted to say the auditor is 4.7% sure. What would be the use in that of being 4? If you're only 4.7% sure of something, just, go for it anyway. Don't bother anymore because it's not going to help you, right? To be only 4.7% sure, okay? So if the auditor is 95% sure that the deviation rate does not exceed what? 4.7%, because that table is telling us it could be that high, right? Okay, good. Okay, now, before we go and see what conclusions we form here, I want you to go back to that previous page because I promised you we would look at that upper deviation rate formula again just to better understand it. Sample deviation rate in our example was how much? Let's write this in. 1% plus the allowance for sampling risk was how much? 3.7%. So we ended up with what? 4.7%, right? The other way to do this is to say the 4.7% was the upper deviation rate, UDR, upper deviation rate, and then we took away the what? We took away the deviation rate. Deviation rate was what? 1%, and that gave us the allowance, didn't it? See how I'm doing that? So I'm just showing you a different way to look at it because that was the way that question, you can flashcard that too, upper deviation rate minus the deviation rate will give you the allowance for sampling risk. And I'm putting that one there too because that's the way that question asked it, didn't it? That question we had on the previous page, right? Okay. Okay, good. So you come over now back and let's see what this sample tells us, okay? And so we take a look and we say we can form conclusions about the internal control, and we say that if the upper deviation rate is less than or equal to my tolerable rate, the auditor could rely on the control, which is sort of old language. The auditor would do what? Determine that the control has operating effectiveness, and we have supported the lower assessed level of control risk, haven't we? Okay. Now, if the upper deviation rate exceeds the tolerable deviation rate, then the auditor could look for some other control that compensates for the control that just failed the control test, or what? Or modify the nature, extent, and timing of my substantive procedures. So instead of looking at internal evidence, I'm going to look at external evidence now. Instead of using smaller sample size, I'm going to use larger sample size for my extent. Instead of doing interim testing, I'm going to do what? Year-end testing, right? Okay, so let's just look at this example, and if the upper deviation rate that we just got from that table is 4.7 and the tolerable rate is 3%, would the auditor rely on that control? Upper deviation rate is 4.7. The auditor would tolerate 3. Would the auditor rely on the control? The auditor cannot rely on that control. Look, the auditor was sitting here saying that what? I'm willing to take 3%, and this table is telling me it could be as high as 4.7%. Is the auditor happy with that situation? I was only willing to take 3. It's 4.7, isn't it? Right? Okay. Okay, good. Now what happens? The tolerable deviation rate is 6%. So now the auditor's up here saying I'm willing to take as high as 6%, and the table's telling me, well, you're down here at 4.7%. Would the auditor rely on the control? Yes. The auditor would determine the control has operating effectiveness. Okay? Now, I think you could turn this question, this very question, into a flashcard. And no, I'm not drawing the state of Nebraska or whatever that looks like to you. This is what? This is sitting here and asking the question on the blank side of the card, and then on the line side, you'll be able to call out the yes or no, right? Okay? Okay, so I think that's a pretty good flashcard. All right, good. That's it for our regular type of control testing sampling. Okay. Of course, you always have to document the sampling procedures. But come over and we have some specialized type of sampling that we can do in an evaluation of internal controls. Okay, and we have something called discovery sampling. We have something called stop or go sampling. Okay, and these are still hovering around the internal controls. Discovery sampling is used when the auditor believes the population deviation rate should be 0 or near 0. We use discovery sampling when we're looking for critical aspects such as fraud. Do you expect to find fraud? You're expecting that there's not going to be fraud, right? So if you want to use discovery sampling, you're looking for this weird occurrence, aren't you? Okay. For example, the company tells us that their cash clerk should never write a check for themselves. And so they say that they think maybe the person is stealing from them, and they want us to do a quick look to see if we see any indications of that fraud. So we pull the sample, and we're looking for the condition of what? No time where the person wrote a check for themselves, right? Now what happens? What if we find one? What do we do? If we find one, then what? Then the auditor would, I'm sorry, let me back up. What if we don't find any? Do we run into management and say, hey, that person's not stealing from you. You can be confident of that. Do we run into them and say that? We still put what? Confidence level and precision on what we're saying, right? And so we say what? There is a 95% chance that the true deviation rate in the population does not exceed 1%. So you can draw those sort of conclusions from a discovery sample. And what does management do at that point? Aha, I knew the person was stealing from us. Whatever, right? They'll come up with the conclusion that they want to there, but we're going to tell them this is where we think the condition of the population is, right? Okay. Now, if deviations are found, then if we want to start to draw different conclusions, we probably better go to a regular sample and start to, be able to give them some more information about what's going on with that sample. Okay. Stop or go sampling flashcard is designed to avoid oversampling, and it allows the auditor to stop sampling before you have completed all what they're saying, all the steps, before you've evaluated the entire sample. What does that mean? Well, if I'm sitting here and I am trying to test if the internal control has operating effectiveness, and I sit there and I pull my sample, I can design it in such a way so that as soon as I find one deviation, I can determine that the control does not have operating effectiveness, right? So I'm looking through, the first one's okay, second one's okay, third one, bam, I find a time card not signed, that control does not have operating effectiveness, right? And at that point, I go ahead and I stop sampling. Now, it would be sad if I went 99, they were all signed, and then 100 is the last one that turned out not to be signed. I'm hoping that that occurrence will come up sooner than that sample so I can stop sampling as soon as I find the deviation. That's called stop or go sampling. Okay? All right, good. So, in a second, we're going to come back and we're going to start to talk about variable sampling that is used for a substantive test, and then we're going to talk about our probability proportionate to size for our substantive testing. And when I say when we come back, I mean when we come back from the multiple choice question. Okay. Yeah, you wouldn't want to sit through a multiple choice question that might actually be on your exam. That would be a complete waste of time, right? Okay, so what's happening? For which of these would the auditor use attribute sampling? What do we use attribute sampling for? Control testing or substantive testing? Control testing. Is there anything up here that looks like it's a control test? Looking at the time card for signature, that was what we been using as our example the whole morning here, right? Okay. Okay, good. How about this one? Okay? Let's take a look at this one. Okay? So, as a result of tested controls, the auditor assessed control risk too low. Did the auditor make a mistake? Did the auditor make a mistake? We assessed control risk too low, right? So this mistake occurred and the auditor decreased substantive testing. The mistaken assessment occurred because the true deviation rate in the population was, let's forget about that question for a second. Let's do a little arts and crafts analysis, art appreciation time. Okay, what is this? What's that? Huh? That's a population of apples. Good. Those are the apples. Okay. Okay, those are the apples. This is the auditor. Started to look like a monster there at first. This is the auditor. Okay. And the auditor does what? The auditor goes ahead and tests 4 of the apples, and it comes back that there's no poison in those apples, right? Okay. The auditor goes ahead then and eats the 5th apple and dies. Okay. Hat fell off. Hat fell off, dropped the apple, the whole works, right? Okay, the auditor's gone, right? The auditor made this mistake because what? Because the true state of the condition, the poison apples, what? The deviation rate in the barrel was more than the deviation rate in the auditor sample, wasn't it? The auditor thought there was a 0%. Meanwhile, there was a whopping what? 1 out of 5, there was a whopping 20% deviation in there, wasn't there? Okay, so what happens? This mistaken assessment occurred because the true deviation rate in the population was what? More than the deviation rate in the sample, wasn't it? Right? Okay. So when you look at these questions, guys, they're going to be testing you on, do you understand the definitions of these different terms, right? And they're going to put them in a scenario like this, and you got to tell them what's happening based on understanding the meaning of those words, right? Okay. Okay, good. How about this one? So when we did a test of details, they're telling us we did a substantive test, didn't they? Right? 2 types of substantive tests, test of details and what? Analytical procedures, right? 2 types of substantive tests. So we sat here and we are doing a test of details, and that's what you use a sample for when you're doing test of details. And the sample indicate that the account balance was materially misstated when in fact it was not. What do we call that? Risk of incorrect rejection, right? Okay, so again, expecting you to be able to read the scenario and what? Interpret the words there and be able to obviously come up with the right answer. Okay? All right, good. How about this one? Let's do this one together. An auditor who uses statistical sampling for attribute and testing internal controls should reduce the planned reliance on the prescribed control. Shouldn't rely on the control when what happens? Before you look at the choices, when do we not rely on the control? Clearly, but when do we not rely on the control based on the terminology in this question and what we've been talking about this morning, right? If the risk of material misstatement is less than the maximum, the auditor will test the operating effectiveness of the controls, right? If the risk of material misstatement is maximum, then I'm not going to test the operating effectiveness of the controls. This is saying that the auditor had determined that the controls had operating effectiveness, did the testing of the operating effectiveness, and did what? determined that the control was not effective. So we're now in the testing of operating effectiveness phase of this whole thing, right? Okay, which is after we've made the assessment of the risk of material misstatement. And if the test told you, what would it mean in the terms that we've been talking about if the test told you could not rely on the control? What does that mean in the terms that we've been talking about? It means that what? It means that the tolerable deviation rate was more or less than the upper deviation. I should probably write the upper deviation rate first, since that's the way we're going to evaluate it. Let me clear that. The upper deviation rate, that the table told us was what? More than the tolerable deviation rate, right? Isn't that when we can't rely on the control? In other words, what? If the upper deviation rate is 4.7% and my tolerable deviation rate is what? 3%, I don't rely on that control, right? Right? And so if you look, item D is saying that the sample rate of deviation, which in our little example that we looked at was 1%, wasn't it? Was 1%? Plus the allowance for sampling risk was what? 3.7%, gave me the upper deviation rate here of 4.7%, didn't it? That's greater than the tolerable rate, which the problem told us was what? 3% in the little one that we were looking at, right? So D is the right answer. You can't rely on the control. The upper deviation rate is more than the tolerable deviation rate, and they were just calling out the components of the upper deviation rate, the deviation rate in the sample plus the allowance for sampling risk, right? Okay. All right, good. So when you look at these questions, guys, you've got to get yourself to a point, and we flashcarded the terminology, but it's really understanding the terminology, right? And once you understand the words, these questions become pretty easy, right? Okay. All right, let's go ahead then. And let's take a look at now what we're doing for our substantive testing around sampling. And we tell you that when we're going to be doing our substantive testing, we could separate the sample into different groups of homogeneous items, and each item is treated as a separate sample. Okay, and this technique is commonly known as stratification, okay? And we use stratification when we have an account balance of population that has highly variable amounts. We stratify the sample. Flashcard that last part there, but let's just use an example of stratification, okay? So let's say I'm sitting here and I have a accounts receivable population, and say the accounts receivable account balance equals, we'll say $100,000. Let's say that my client has 10,000 items, 10,000 accounts, 10,000 customers in there. We'll call them customers. 10,000 customer accounts, right? Okay, there's 10,000 customers. Do I want to look at 10,000 accounts receivable? No way, right? I'll be there my whole life. So I start to look at that population, and I see that there's the first one is worth 10,000. I rank them in terms of size. The second one is 10,000. The third one is 5,000. There's a fourth one for 5,000. And there's what? There's a fifth one. There's 5,000. Okay? And I'm sorry, guys. I don't want to make it 10,000 because that's going to make the math too hard on us. Let's say it's instead of sitting there being 10,000 customers, is 1,000 customers. In fact, we'll make it 100 customers. I want the math to be easy. 100 customers. And again, I might look at all 100, but let's say I don't want to look at all 100, right? So what do? I'll sit there and and then when they go through 6 through what, 100? 6 through 100, they average, we'll say like, $250. And please don't somebody do the math on me and say, well, that's impossible. Okay, but let's say the rest are relatively smaller ones, right? What the auditor would do in a stratification is the auditor would go ahead and grab off those top 5, right? Grab off those top 5, and I would look at all of those, wouldn't I? And when I look at all of those, I'm getting, what's the total of those? 10 and 10, 15, 25,000? 35,000? Okay, thank you. So when I'm looking at that, I'm getting what? I'm getting $35,000 worth. And I'm going to divide that by the what? By the 100,000 account balance, right? That 100,000 account balance. I'm getting 35% coverage there, right? 35% coverage. Meanwhile, I'm looking at 6 out of 100. I'm only looking at what? 6% of the items, right? So the auditor has stratified that sample by sitting there looking at the big ones, getting higher dollar coverage for less work, right? And I only have to send out confirmation. Well, I would send out confirmation definitely to those 5. And then for the remaining 95, I might take a random sample of those. And yes, those I'll get some coverage through sampling, right? That's called stratification, okay? Do auditors like it when they have a population like that? They love that, right? Because great, I'm going to get big audit coverage and what? Not have to be more efficient in how I go about doing my work, right? Now, we talk about tolerable misstatement, and we talked about tolerable misstatement in A3, and remember we said that the auditor comes up with the overall financial statement materiality, the level as to which if there's a material misstatement it would cause the financial statements to be materially misstated, and we're going to ask for an adjustment for that, or we're going to have to modify our opinion, right? Give a qualified opinion, adverse opinion, whatever. Okay, now what happens? We also said that we took that overall financial statement materiality and we came up, and remember I said we couldn't call it performance materiality if we're sitting there and we're doing a non-sampling procedure, or we would call it tolerable misstatement if we were applying the sampling procedure. And when we do that, that is now going to be assigned at the account level. And we're going to be looking to make sure that that account is not materially misstated through that tolerable deviation rate. We do this to, tolerable misstatement, tolerable deviation rates for our control testing, right? We do that to make sure that there aren't undetected misstatements that, not to our knowledge, have piled up and eclipse my overall financial statement materiality. So we're going to be applying this concept of tolerable misstatement now, and now we're going to see how it would work for sampling. Okay, so we say that tolerable deviation is the maximum amount of misstatement that the auditor will accept, and we're down at the account balance, assertion level, transaction level. They don't mention disclosure because you don't use sampling for disclosure, but we are concerned about misstatement disclosure level too. But at this point, we're account balance transactions. We talked about that in Audit 3, and I asked you to flashcard that at that time, but you can flashcard it here as well. Now you come down and you take a look, and what the auditor will do is take a look at that tolerable misstatement, and we will compare it to our projected misstatement. Okay, so we come down and we take a look, and what? The auditor, where's my projected misstatement? I pointed to the wrong thing here. Sorry guys, keep coming down. Don't connect it there. Let me erase that. Don't connect it there. Tolerable misstatement is going to be compared to my buddy what? Projected misstatement, which is down here, right? The projected misstatement, okay? And projected misstatement now is what I'm going to estimate the misstatement is in my population based on the sampling that we're going to be talking about here. And we're going to talk about variable sampling. We're going to talk about PPS sampling for this, okay? So the first thing I want you to do is draw another arrow. See this arrow? See it going over? See it coming up? Now it's going up. Isn't this fun? Okay? It's going to cross over to the other side of the world and come out on the other page, isn't it? Okay, so just come over now to the next page. And when you come over to the next page, keep drawing over to my variable sampling plans. These are the ways that we're going to use variable sampling to project the misstatement. We'll compare that to our tolerable misstatement to see if we believe that there needs to be an adjustment in the account balance for it not to be materially misstated, right? Okay, and there are 3 sampling plans that they talk about here, variable sampling plans: mean per unit, ratio estimation, and what? Difference estimation. Okay, so these are the 3, and we go ahead and we take a look at these 3 methods, and let's first look at this mean per unit. This mean per unit, okay? And with mean per unit, we're going to go ahead and we're going to come up with a point estimate. And the point estimate is going to use the average value of the sample items to estimate the true value of the population. And we call that a point estimate. Okay, so that point estimate, you can write point in here if you want. Point estimate. That should say point. The point estimate, and the way we calculate that, is to take the average of the sample values times the number of items in the population. Okay, well, what does that mean? You can write over here an example here. Let's say that the auditor looks at the accounts, and we're looking at accounts receivable, and the population equals 10,000 items. 10,000 items. Why am I putting a dollar sign? 10,000 items, right? 10,000 accounts. 10,000 accounts. Does the auditor want to look at 10,000 accounts? Do we want to send out confirmation to 10,000 customers? No. So we're going to take a sample of that, and let's say the sample size equals 10 accounts receivable. Now look, I know that 10 accounts receivable is not representative of 10,000, but I don't want to sit here with 100 items and explain what's going on, right? So the auditor looks at what? Looks at 10 accounts receivable, and they go ahead and they send those 10 items out for confirmation. And sample item 1 comes back at $200. Sample 2 comes back at $300, whatever. How many items am I looking at? 10. Okay, so I go through the 10. I'm not going to write 10 numbers here, guys. The auditor totals that, and there's 2,000 of these. $2,000, I should say. $2,000. Okay. The auditor takes that $2,000 and divides that by 10. So the average sample value here, average sample value is $200, isn't it? Right? 2,000 items divided by 10. Do I have an average sample value of 200? I take that and I multiply that by how many items? 10,000 accounts, right? 10,000. And I get my point estimate using mean per unit. That says point estimate. Point estimate using mean per unit is $2 million, isn't it? Hello? Okay. So I have a point estimate of what I think the recorded balance in the account receivable is, right? By using mean per unit. Okay. Now I'll compare that to what they actually have recorded in the account balance, and what? If it is different by more than my tolerable misstatement, I'm going to ask for an adjustment, right? If the difference, it's not going to be exact, right? It's an estimate. If my difference between what they have recorded in this $2 million is what? Less than my tolerable misstatement, I'm happy, right? Okay? Okay. Now, That's mean per unit, and the takeaway from that example is right here that you should flashcard. Mean per unit did not require that I knew the book value of the sample items. Show me anywhere in this example where I went in and looked up the book value for those items. I did not. I simply did what? Picked the 10 items, sent out the confirmation, came up with the point estimate, compared it to what they had recorded in the GL, and I didn't have to go back and look at each individual item to see what it was recorded at in the financial statements, right? Okay. Okay, now that is different than ratio estimation. Okay, ratio estimation is a technique when the calculated audit amounts are approximately proportionate to the book amounts. So now, flashcard, I am going to have to sit here and look up the book amounts of each audited item. Okay, so when we come up with the ratio estimation, we're going to compare the correct audited values to the book values to come up with our ratio estimation. So let's say I have a client, I send out confirmation, say for 10 accounts receivable, and the audit value for those 10 account receivable, AV is audit value. Audit value is, say, $25,000. So I send out 10 confirmations. They come back to me. I look at what the customer's client has said they owe, and I add up for those 10 confirmations. The total is how much? 25,000, right? Because I looked those items up. Then, because I sent those confirmations out, then I looked those items up in the client's subsidiary ledger, and for those same 10 items, the client has recorded what? 27,500. So there's a little difference there, isn't there? Isn't there a little difference between the book value and the audit value? But on a ratio basis, audit value is constituting about 90%, right? It says 90%. Audit value is constituting about 90%. Let me rewrite that a little better. Audit value is constituting about what percent? 90% of the book value. So now I look up the book value of the entire amount in the GL, and the entire amount in the GL is, say, $550,000 now for accounts receivable. So 550,000 times 90% gives me what? About 500,000? Now clearly there's a $50,000 what? Misstatement that I'm thinking that's in there based on my sample. And if that 50,000 is what? Within my tolerable misstatement, I'm ready to go. I'm fine. If the 50,000 exceeds my tolerable misstatement, now I'm going to ask for some sort of adjustment or something, right? Okay. Now again, I had you flashcard the takeaway. Ratio estimation is highly efficient technique when the calculated audit amounts are approximately proportionate to the client's amounts. Was that the case here? We were pretty close. We were about 90%, right? So we were pretty proportionate. Now, difference estimation is something that we will use when the ratio of the estimated to the audit value to the book amounts are not proportionate. And we're going to get onto that in page 17. And you can put C, page 17. We're not going to go there now, but I'm going to show you over there where there's a numeric example that I think helps us understand that a little bit better. But if you look at the three flashcards here, what? It was all about book value. In one case, mean per unit, we didn't have to know the book values, right? In the other case, what? Book value was proportionate to audit values. And in the other case, we what? We use it when it was not proportionate to the book amounts. Okay? So I'll wait for you to remember those three. Okay, good. Now you come over and you take a look, and we need to determine sample size now. And I want you to just see the table on the next page. Just go to the table on the next page, come over, and I want you to make 6 FCs out of this table. I want you to make 6 FCs out of this table. 1, 2, 3, 4, 5, how many? 6 flashcards, 1 for each row. I want you to get rid of this last row. And when I say get rid of it, you don't need to make a flashcard out of it. And you don't need that last column on the flashcards. That's all I'm doing. I'm saying get rid of it. I mean, you don't need to tear it out of your book, but you don't need to make a flashcard out of it, right? Okay, now let's look at this thing. And this is determining now our sample size. And they're saying our sample size for a test of details. So they're telling us what? For our substandard procedures? 2 types of substandard procedures. What are they? There is what? Test of details and substantive analytic. Do we have to do the substantive analytic? Do we have to do substantive analytic? Do we have to do substantive analytic? If I'm still looking at you, that means you're not nodding the right answer. We do not have to do substantive analytic. That is optional. You don't have to do a substantive analytic. You have to do analytical procedure in what? Planning phase. You have to do it in the final review phase. The substantive analytic is optional, isn't it? We did the washing machine revenue example, right? Okay, so, but this is the test of details part of our substantive where we're going to use sampling. And they're asking us, do we know how sample size will be affected by these different things, right? And when you look at this table, you already know the answer, don't you? You already know the answer? Well, it's kind of hard to see from here, huh? Okay, so what happens? It's in your book. Okay, good. Yeah, you might want to look at it in your book. It's a little tough to see from back here. But what happens? In fact, you guys have young eyes, so you could probably see it. I need to get closer. I can't see it from back here. There was a time where I could. Now I can't. Okay, so how close do I have to get here? Okay, now I can read it. Okay, so what happens? So if we have what? Assessment of our inherent risk, right? And if we assess the inherent risk and we assess the inherent risk at high, that means our risk of material misstatement is going up. That means that for my substantive testing, my what? My extent now. And we're just talking about extent now, aren't we? It's nature, extent, time. We're just talking about extent. Larger sample sizes for my substantive testing, right? So you know this already? If my what? Inherent risk is down, my risk of material misstatement is down. My risk of material misstatement is down. My what? My detection risk can go up. If my detection risk can go up, nature, we're talking about extent. Smaller sample sizes for my sampling, right? For my tested details. Okay, you know these. Control risk, same thing, right? Do I need to go through that? Control risk is up. If you didn't say no, I'm going to do it. Control risk is up. Risk of material misstatement is up. Detection risk has to come down. Detection risk has to come down. Extent, larger sample size, right? Control risk is down. Risk of material statement is down. Risk of material statement is down. My detection risk can go up. My detection risk goes up. My sample for my substantive testing extent can come down, right? Okay. Look at this one. Assessment of the risk of measure of tolerable misstatement. Number 4. Let's look at number 4. Measure of tolerable misstatement. What happens? I have a client that has a $2 million worth of assets. And I tell you that a 2-cent error could cause the financial statements to be material misstated. 2-cent error. 2-cent error in there, the financial statements are material misstated. You're like, no, don't do the audit. You'll never find a 2-cent error, right? But if I was so adventurous that I was going to go ahead and do it, I would have to take a gigantic sample size to find a 2-cent error, right? Okay, so what happens? If my tolerable misstatement is lower, larger sample size for my substantive testing, right? If I tell you the client has $150,000 of assets, and a $2 million error is what is considered a material misstatement, just sign the opinion, right? You're not going to have to do any audit work because there's no way you're going to have a material misstatement of $2 million in there, right? Okay, so what happens? Larger tolerable misstatement, smaller sample size, right? Okay, then what? Then we come down expected size and frequency of misstatements. I have a client that's driving drunk. They mess up all the time. What am I going to want to do? Large sample size so I can find all those stupid mistakes. If I have a pretty clean, smart client, smaller sample size, right? You say, well, how do you know that? Based on past experience with the client, right? And the standards allow us to consider past experience with a client. Okay, so this is very similar to the table that we saw for control. It wasn't a table though, but the thought process very similar to what we saw for our sample size for control testing, right? Examiners love to ask questions about sample size. All right. Okay, good. So you come down, and let's take a look now at evaluating the sample. And we're going to have some numbers here that go through and give us some different information about this sample. And then on the next page, they give us practice with mean per unit, ratio estimation, and difference estimation. Now, I'm going to have you study those first two for homework because we already went through our own little examples that we wrote in next to those. Remember that? Okay, but this one, let's go ahead and let's take a look at what they do here. And so they come over for this one, and they tell us that they had a book value of $824,200, an audit value of $175,000. There were 200 units, 200 items in the sample, and there are 5,000 units in the population. So they project an error of 230,000. And the auditor would need to look at that and see if that error was in our tolerable misstatement. If it's not, I'm going to ask for the adjustment, right? Okay. Now, there's a little different way to look at this. First off, they give us what? They're giving us this difference is 9,200. 9,200 divided by what? 200? That's just that difference right there. Divided by 200 times the 5,000 will give them this projected error of 230,000, right? I'm just doing a little bit of the math for us there so we can see that 9,200 is what I wanted to do there. It's the only thing that's different. I could write this a different way. If there's 200 items in the in the sample, 200 items in the sample, and 5,000 items in the population, what percent of the items did I look at? Not a trick question. Okay, I guess it's early and your calculators are probably still sleeping. 200 divided by the 5,000 is 4%, right? Okay, so I've looked at 4% of the population, haven't I? And when I look at 4% of the population, I could look at that and say, okay, 0.04 times the misstatement in the population. Misstatement in the population should equal 9,200, shouldn't it? I've looked at 4% of the items, and in looking at the 4% of the items and looking at those 200 items, I found misstatement of 9,200, didn't I? So 0.4% of what I believe to be the misstatement in the population should equal 9,200, shouldn't it? How many items did I look at? I looked at 200 out of 5,000. That's 4% of the population. And in looking at that, I found a misstatement of what? 9,200. So 4% of the total misstatement in the population, which is the unknown I'm going to solve here for, should equal 9,200, right? Right? Okay. So I take that 9,200. I divide it by 0.04. What do I get? You get 230,000, don't you? Which is what I'm projecting the misstatement to be here. I'm just showing you another way of looking at the same thing they put in front of us here, right? I'm sitting here and I'm saying 4% of the misstatement. I looked at 4% of the items, 4% of the misstatement is equaling the 9,200, and then I come up with the projected misstatement, right? Because the examiners are under no obligation to give you all of the variables and say, okay, using difference estimation, now calculate the projected misstatement. That's not necessarily how they're going to ask it, right? They could ask you to come up with a misstatement, giving you what? The information, the percent of the population you looked at, the amount of error in the population, and then they're going to ask you to determine what the projected misstatement would be. You'd have to do it this way, wouldn't you? Okay, so look at CPA dash 0 02585. CPA-02585. Is that the one I want you to look at? Okay. And let's go ahead and let's just take a look at that one. Okay. Too long. I just did it this morning. Give me a break. Okay. So let's go ahead. Sorry. I talk to my computer all the time. Okay. So let's go ahead and oh, by the way, I just updated it this morning, and when I did, I noticed they have indicated that there are newly released AICPA questions that came in the latest update. So you need to have the latest update. You should read 63 of 63 to know that you have the latest update, and you should go through those most recently released questions. I always take a look at them and see what the trend is and some of the things they're asking. Okay, so you should be looking at that. Okay, but anyway, we're going to look for what? Find question. Okay, well, give me the keyboard, please. Keyboard. Gets ponderous at some point. It's not going to give me the keyboard, so I'll get my own keyboard. CPA what? 0 what? 02585? Okay. Okay, good. All right, and you can see this, and we say that the auditor did what? The auditor established 60,000 is my tolerable misstatement. Now I'm going to have to write on the board here because I can't write on this question. But it's what? 60,000 is my tolerable misstatement. And I want to see if using difference estimation, if I have exceeded my tolerable misstatement, right? So I come over and I look at this, and they tell me the auditor selected a sample of every 20th item. If I'm looking at every 20th item, 1 divided by 20 is going to be what? Huh? I'll wait. 1 divided by 20 is 5%? Okay, so 1 divided by 20 is 5%, 0.5%, isn't it? Okay, so I take that 0.05 and I sit here and I say that I want to see what the misstatement is. And they tell me that there were overstatements of 37,000 and understatements of 200. Hey, if there had been overstatements of 3,700 and understatements of 3,700, I'd be done, right? If I was so lucky, okay? But what? I net the overstatements and understatements so that I have a 3,500 now net misstatement sitting there. Okay, so that's the net misstatement. And then I just go ahead and I set that up 0.05 times whatever the misstatements are should equal 3,500, shouldn't it? Right? And I take the 3,500 and I divide that by 0.05, and that's telling me that there's a projected misstatement here using difference estimation of 70,000, isn't there? Is the auditor happy with the projected misstatement of 70,000 when I have a tolerable misstatement of 60,000? The auditor is not happy with that situation, right? And so what happens? The auditor would start to ask for some sort of adjustment or something, right? So what's the answer? There is an unacceptably high risk that the actual misstatement of the population exceed the tolerable misstatement based on the sample, right? Okay? Okay. So I'm just showing that to you because we sort of show you the difference estimation, in the way we, articulate it here in the book, as though the examiners are just going to hand you all of the, things you need. Meanwhile, they made you back into something, didn't they? Okay. Okay, good. We're going to go a little bit over the break time, guys. Obviously, we're already over it. So hang in there. After we do the mean per unit, we'll take the break. Okay. All right. So let's just come back now and let's take a look. You're kidding me, right? Okay, well, I guess we're going to take the break right now, aren't we, since the computer's going to malfunction on me. So let's just go ahead, take the break. I'm probably going to have to reboot the software, and we'll come back in 10 minutes, guys, and then we'll just go through to the end. So we'll just take a break now. Now, computer's back up and running. And let's just go ahead now and take a look at how we would form the conclusion on the account balances. Okay. And we say that in deciding whether the client's book value is correct, we'll come up with a point estimate, and then we'll have a plus or minus allowance for sampling risk. Okay. And so I'm just going to go back to that point estimate. Remember the mean per unit one that we did where we had the 10 items and the total was 2,000 the sample. Average value was 200. We multiply that by the 10,000. Remember we came up with our point estimate. And our point estimate in our little example was something like $2 million, right? We're just going to write it down here for our point estimate was $2 million. Okay, and then we say that the auditor will come up with a plus or minus allowance for sampling risk. Okay, so I'm just going to make this up, guys. I'm just going to tell you that the allowance for sampling risk turns out to be the standard deviation for the sample, but we're not going to get it. I'm just going to make up a number. That the standard deviation, and it gives us a plus or minus, could be plus, and I'm just making this up, plus 100,000. Didn't line that up right, but that's all right. Plus 100,000 or what? Minus 100,000. So that means I'm saying that this population, I believe that the population value could be what? As low as 900,000 or as high as what? 2.1, right? With me so far? Okay. Now the auditor looks and the auditor has a tolerable misstatement. And say my tolerable misstatement is $300,000. Remember I came up with my tolerable misstatement by doing what? Overall financial statement materiality, and then I took a percentage of that to come up with what my account balance misstatement would be, right? Okay, so I have this 300,000, and let's say that the recorded balance is 2 million. Oh, since my tolerable misstatement is 300,000, that means I'm willing to go up to a misstatement of how much? Or a recorded balance up to 2,400,000. Just looking at the upper end, I'm not going to do the lower end, but it would be down what? 1,600,000 on the lower end. But I'm willing to go as high as 2.4 and still not have a material misstatement, right? Because my tolerable misstatement is 300,000. So let's say that the client's balance is 2,050,000. That's what they actually have recorded. Is the auditor happy or sad? The auditor is happy because I'm sitting there and saying, wow, even with the allowance for sampling risk, I'm still good, right? Okay. Let's say they have recorded 2,300,000. Happy or sad auditor? Still happy because I'm willing to go up to what? 2.4 because I have a tolerable misstatement of 300,000, right? So if the recorded balance is, say, and I think you know where I'm going, 2,600,000, and it didn't have to go that high, it only had to go over the 4, but obviously the auditor is now what? Now the auditor is sad because I'm sitting there saying, look, I figured you should be around 2 million. I figured I'd give myself a range between 1.9 and 2 million before I'd even really start thinking that you were out of a tolerance level. And then I was even willing to hang with you all the way up to misstatements, all the way up to 2.4. You're at 2.6. I can't hang with you. I can't tolerate you anymore, right? So what am I going to ask for them to do? Huh? I'm going to ask for an adjustment. I'm going to sit there and say, can you please adjust this account receivable balance down? I would like you to credit the account receivable so that it comes down to at least what? 2.3, right? Nancy?
When you go over the allowance for sampling risk
Mm-hmm.
threshold that you talked about, the 2.1,
Yeah.
but you're under the materiality your total materiality threshold,
Yeah.
is there a point where you kick in more procedures or sampling, or
Um,
kind of a weird question?
yeah, I mean, I would think that the answer is the closer you get to the 2.4, the more likely it is that I'm going to start getting some additional sampling procedures because there's still potential undetected misstatements. And as I start getting closer and closer to exceeding my tolerable misstatement, then I start saying, I'm $1 under. Well, that's too close for me. And I'm going to expand my sample sizes to see what's going on.
Well, I'm just wondering because it kind of is theoretically like the sampling risk. When you get outside of it, you're still in the clear under the 2.4. So
Whoa, whoa, whoa. When you're the sampling risk, you mean the range here?
yeah, when you're outside of the range that they're talking about.
Oh, the allowance for sampling risk. I'm sorry. Yeah.
But you're under the materiality risk. It seems like a really gray area.
Well, what this is telling me, this between the 2 million and the 2.1, when do I start counting these as misstatements? Now I'm over, right? And now once I get over the 2.1, now I'm thinking misstatement for everything that piles on top of that. If they're within that range, I'm thinking there's not even a misstatement in here because it's a sample and there's a chance that the sample will not be representative, so I give it and here we do care about the minus because an amount that's below would also be a misstatement. So I put a precision, and it's not until I start to get past that upper end of the precision that I start eating against my tolerable misstatement, right? And I still live with them up here because I'm still saying, nope, not material misstatement, not material misstatement. I get to 2.401. Now I have a tolerable misstatement, and I need to do something about that, right? And I'm saying that as a conservative auditor, I might start getting close enough to 2.4 that I'm saying, we're expanding the sample here, man. This is way too close because there's a chance that there's something that, this is a very weird population. And there's always a chance that, because even this, I would have had a confidence level. I would have been sitting there saying, I'm 95% confident, and now my 95% confidence is starting to get a little shaky if I'm getting close to the upper end of the precision on this thing, right? So I might at that point go ahead and pull a larger sample. But what would I do when I get to this 2.6 or more than 2.4? What would I start asking them to do? 2.6 in this example. I'm asking for an adjustment, right? And now I'm sitting there and saying, can you adjust the account receivable down to 2.4 and I'll hang with you on that? I don't mean hang in a bad way, hang in a good way. I'll hang with you on that. And what does management say to me? What does management say to me? Is management happy if I ask them to adjust down the account receivable? No, because if I credit account receivable, I have to debit something, right? What am I going to debit? Sales. If I debit sales 200,000, I might wipe out a net income. I might turn a net income into a loss or something stupid like that, and they might not be too happy with that, right? Okay. So if they don't make the adjustment, what do I do? By this time, I've already done the more sampling. Okay. If I'm sitting there and I got the, to walk in and ask for an adjustment, I'm not thinking that another sample size is going to change something. In fact, I might go ahead and pull the additional sample, confirm that I'm right, go in, tell them that this is what I did and I would like an adjustment. And when they say you're wrong, I'll say, okay, I'll pull a bigger sample and I'll go into the other room and I'll go Okay, I pulled a bigger sample. Here's the results, right? But I would already be pretty sure of what it is I know, that's going on, right? Okay, so what happens? So I would probably pull it in advance, right, and then tell them. So you tell them going right in, well, we pulled a bigger. They're gonna say, well, pull a bigger sample, right? So to avoid that, pull the bigger sample first. Tell them you'll pull a bigger sample, and then okay. Anyway, so what will I do if they refuse to make the adjustment? Qualify opinion if it's really bad. Adverse if I think they're trying to be deceptive, misleading. Withdraw at that point, etc. Right? Okay, we go all the way back to audit 1. Okay? All right, good. Okay, so that's all that's going on there. Now you come over, and as I mentioned, we are going to talk about something called probability proportionate to size sampling. We have also seen it called DUS, dollar unit sampling. Okay, probability proportionate to size. You could also call it dollar unit sampling. What happens here? Well, now my client has their accounts receivable again, let's say, and what I'm going to do is I'm going to go ahead and I'm going to sample dollars in my client's account receivable, and when I sample a dollar, I find the dollar in a particular client's account, and I audit that entire account, but I'm really, from a statistical standpoint, auditing that dollar that's in that account. Okay, so what I'm going to do is I'm going to pretend like everyone in the class here represents one of my client's customers. Everyone in the class is one of my client's customers, and my customer has $500,000 of account receivable. Now, all of you have dollars in front of you that represent what you owe my client. So that means sitting around the table, there's $500,000 bills sitting on here. Kind of a nice thought until you realize that that's money you owe to my client, right? Okay, so we're sitting here with all these dollars, and I'm going to go ahead and I'm going to sample dollars. Okay, and each person needs to remember their dollar. Okay, now I have a sampling interval. My sampling interval is every 5,000th item. Every $5,000 is my sampling interval. Okay, and I'm going to go through the dollars. Each time I find my $5,000, I'll pull that account for my sample. So, what's your name again, sir? Andy. Andy, so you've got, I'm looking for my $5,000, right? You've got $500 sitting in front of you. Do you have my $5,000? I'm starting with you. I've gone through 500, no $5,000 there, right? So I go to the next person. Remember your amount. I go to the next person. What's your name?
Joji.
Joji, you have $2,500 sitting in front of you. Do you have my $5,000? No, you don't, because I'm only through $2,500 so far, right? I mean, $3,000? That's what I want you to remember, because I forget. I'm through $3,000 so far? Okay, good. So I'm through $3,000. Andrew, you have $4,000 sitting in front of you. Do you have my $5,000? Yes, you do. I've gone through what? I've gone through 5, 25. That was 3. What did I say? 4. 7, somewhere in the middle there, I found my $5,000, didn't I? So I sent out a confirmation for your entire account balance, and in doing that, from a statistical standpoint, I'm testing now that first $5,000, right? Now I'm looking for my $10,000, right? Every 5,000, I'm looking for my 10,000. So far, I've gone through how many? 7, okay? And I come over to the next person. What's your name? Jennifer. You have how many have I looked at so far? 7. You have $8,000 sitting in front of you. Do you have my $10,000? I mean, yeah, my 10,000. We know you do, because you're bigger than an interval, right? Any account that's bigger than the interval is automatically going to be selected if I'm looking for every $5,000. And we were at 7 plus 6, we're what? Plus 8, we're what? 15,000. So what happens? Jennifer has my what? Has my $10,000 and my $15,000. So when I send out the confirmation to Jennifer, I'm going to do what? I'm going to test 2 of the items in my sample, right? Auditor loves that because I send out one confirmation. I'm getting 2 sample items looked at, right? Those $2 in her account, okay? Okay, so what happens? Notice the big ones that got selected. How much did you have? You had 8. 4 and 8 got selected. 25 and 5 didn't get selected because they were smaller. Now, I designed it that way, obviously, but what? The probability proportionate to size, if you think about it, the more dollars you have in front of you, the more likely it is that your dollar will be selected, right? Probability proportionate to the size of your account, right? Okay? Okay, now, looking at that, that example now, the advantages of PPS sampling is it automatically emphasizes larger items by stratifying the sample. It automatically stratifies it. Before, we had to go out and hand pick the individual ones that we wanted. Here, what? Just going through automatically stratified them, right? Now you're sitting there saying, yeah, but that could take you 1,000 years, John, to go through and find every $5,000. There is software now that you simply run your client's account system against that, your software against your client's system, and it goes and it picks the items that meet the dollar requirement, right? And the computer does that. We use at GAO, we use probability proportionate size to audit the public debt, which at that time was $5 trillion. But can you imagine if our sampling interval was every $5,000 and we had to sit there and do that with a calculator? We'd still be there, right? Okay, so what happens? The way we did it is we just ran our they call the system idea against the client's system, and the next day it had the sample items for us, right? And so the computer obviously can do that very quickly. Okay, so that's an advantage of PPS. Okay, it automatically stratifies the sample. Flashcard that. Disadvantage of PPS is going to be that 0 or negative balances will never be selected. If you have zeros or negatives, how are they going to be selected? Because they have no dollars in front of them. Therefore, what? You have not given yourself a random sample because some are what? Being pre-selected for non-selection, right? Now, what happens? You can design around that. If you have zeros or negatives, I'll tell you, if you have zeros or negatives, okay, if you have zeros or negatives, you just pull those out and do a separate sample with the zeros, and the negatives, you're going to do 100% look at those, because why are they negative? If they're really a negative receivable, they're actually a payable and need to be reclassed, don't they? Okay, so you can design around that, right?
But if they're zero, does not mean that you want the material?
Not if they're not supposed to be zero. Not if we're testing for the existence assertion and they're not supposed to be zero. And they're not supposed to be zero. Take that second not out. And they're not supposed to be zero, then we would look at them, right? Okay? Now, you don't have to look at every zero. If there's a lot of them, just take a sample. Okay? Okay, good. So you come over, and let's just see how we're going to determine the sample size down here. And we're sitting here, and we have our sampling interval is going to be whatever our tolerable misstatement was that we came up with, and we talked about that, how to do that in Chapter 3, divided by our reliability factor. Okay, then we're going to take that sampling interval that we just calculated above, and we're going to use it as the denominator here, and we're going to divide that into the recorded amount of the population to get the sample size. Okay, now you come over, and this notion of how to come up with the sample size, to me, guys, is more of a learning opportunity than something you need to worry about for your test. But just come over, and we talk about the risk of incorrect acceptance, and we have correlated reliability factors with those risk of incorrect acceptance. Now, if you're asking me where did this come from, some genius must have sat there, and I don't mean a Becker genius, I mean a real genius must have sat there somewhere and did what? Calculated how to correspond reliability factors to risk of incorrect acceptance. And so for this particular one, the risk of incorrect acceptance was 5%. That means the auditor wants to be 95% sure that I will do what? correctly accept the account balance, right? I only want a 5% chance that I'll make the wrong decision. And so when I do that, I take the $15,000, which they told me was the tolerable misstatement, which you see right there. I divide it by that reliability factor that's just given to me, and that means my sampling interval is what? 5,000. I go ahead and I take the what? The 500,000. I divide that by the sampling interval. That gives me my sample size of 100. Okay. Now, just to sort of have more of a takeaway from this than just seeing the mechanics here, let's say my tolerable misstatement is, as they said here, 15,000. But now I have a very conservative auditor that only wants to, or maybe they're in a particular client that is, they figure that there's a lot of risk associated with that, whatever, and they only want a 1% risk of incorrect acceptance. So we get a different reliability factor, don't we? Now we want to be 99% sure. So we go ahead and we divide that now by the reliability factor of what? 4.6. And when we do, we come up with a sampling interval here now of what? 3, where did I write my sampling interval? 3,261, roughly. Okay, so now what? Now I take that recorded account balance, the 500,000. I divide that by 3,261, and now I get a sample size of what? 153? 153? Okay, roughly. So what happens? Did we lie that if you what? If you're trying to get your risk of incorrect acceptance down, you need a bigger sample size? We got a bigger sample size, didn't we? And so our risk of incorrect acceptance is coming down, bigger sample, right? Okay. All right. That's more the takeaway of that, in my opinion, guys, than the mechanics as to how to get the sample size. And there may be a homework question there where they have you going through the mechanics of the sample size. I'm of the opinion that the examiners are going to be more interested in, can you just understand what's going on with these sample sizes related to the risk of incorrect acceptance. Okay. Okay. Now you come over, and now we continue on with this example, and we have a random start of 300 units. Random start of 300 units. In my little example, I violated one of the rules, which was a random start, didn't I? Okay, so you wouldn't want to do that. You start with a random number. You go to your random number generator, whatever your computer, and it gives you 300. Your first item will be the $300. Your second item will be the $5,300. Your third will be the what? $10,300, $15,300, $20,300, and so on, right? Okay, and again, this is describing this the way you would do it if you were in the desert somewhere without with rocks. You would do it this way, okay? We would do it with a computer, and it would automatically go through and trying to find now the 5,000, first the $300 and then the 5,300. So I go to this first guy. He has $150. Does he have my $300? No, he doesn't. He's only got $150. So I go to the next guy. I add him up. Now I've gone through $950. Does he have my $300? Excuse me. Yes, he does. And so I go ahead, and that star means I'm going to select him. I'm going to send out a confirmation, right? For each one of these that I select, I'm going to send out the confirmation. It says confirm. Okay. All right. Now I'm looking for my 5,300. I add in the next guy, and he comes to 2350. Does he have my 5,300? Does he have my 5,300? No, he does not. Right. So I add in the next guy. When I add him up, now I'm up to 6,700. Does he have my 5,300? Yes, he does. So I add him in. Right. Okay. I'm going to send the confirmation to him. Okay, good. Then what? Then I come up to this next one. I'm looking for my 10,300. I add in 23. Does he have my 10,300? Does he have my 10,300? No, he doesn't. So I go to the next guy. I add him in, and when I do, does he have my 10,300? Yes, he does. So I send out the confirmation to him, right? I add in this next one, and look, this one is 8,500. I know this one's going to be selected because he's bigger than the interval, isn't he? So he has to have one of the 5,000th. I'm looking for what? I'm looking for my 15,300 here now, right? And when I add him in, notice it goes to 22,400. That has not only my $15,300, but also my 20,300. It's like the one with Jennifer, isn't it? Right? So when I send that one out, I'm going to get to test 2 items. And I continue on like this, guys. I'm not going to go through the whole table because we'll go into a coma here if we do. But if you keep going here, you will continue that process, right? And again, the machine would do it for us, right? Okay. Okay, good. Now you come over and you take a look at the next page. And now we have the evaluation of the sample results. So we send out those confirmations. The first guy, it had a recorded amount, remember, of 800. And the confirmation comes back, says 600. There's a $200 error in there, isn't there? I divide that 200 by the recorded book value, and I come up with, and they call that a tainting of 25%. So I have tainting of 25%. I multiply that times what? Times my sampling interval, and that gives me, for that interval, my projected error is 1,250. So I'm projecting error now in this sample. Instead of doing it for the whole population, like I was with mean per unit, etc., I'm projecting error an interval at a time, right? So I'm probably going to get a little more reliable results by doing this. Okay, so I go ahead, I go to the next guy. He says yes, he owes 4,350. That means there is what? No tainting. If there's no tainting, there's no error, right? It's projected for that one. Okay, I go to the next guy. I send out confirmation to him, and when you read these confirmations, sometimes they have some colorful comments in there. Are you crazy? What is wrong with you people? You know, da-da-da-da-da. Sometimes you get a little bit of a sense of what the relationship with this client has been by reading the answer. They think they're talking to your client. They're talking, even though the confirmation is coming right back to you, right? Okay? And so you read through that, and you're kind of saying, oh, boy. And what? We have 100% error here, don't we? And so we project that entire interval to be in error, don't we? Okay, now this is where it gets interesting. So if you're texting on your phone, stop so that you can watch what's going on here. So we go to this next one, and this next one is 8,500 is what the recorded balance was, and the guy comes back and says, no, I made a $1,600 payment, I only owe you $6,900. So there's a $1,600 error in there, isn't there? We do not taint for that error. We take that error straight over to the projection column. Take that straight over to the projection column. Why do we do this? Well, if you sat there, and don't write this down in your book because I don't want you to think that this is the right way to do things. This is wrong. I'll just put, this is wrong. Wrong. Bad CPA. Don't do this. You take what? You take 1,600, the error, right? And if you divide it by the recorded book value of 8,500, you get roughly about 19%. If you take 19% and you multiply that by the interval, the way we've been doing, you would get a projected error of 941, which is a nonsensical result when we know that the error is 1,600, isn't it? Why would we project an error of 941 when we have an item in our hand that tells us the error is 1,600, right? So you don't project like that when the item is bigger than the interval, because it's really representing more than just an interval, isn't it? It's 8,500, right? Okay, so don't do that. No. Bad. Okay, don't do that. Okay, you just take the whole error over. Now I go ahead and I do this next one now, $300 the error, divide that by the 1,500, gives me 20% error, multiply that by the 5,000 to get the tainting, and then I add all of those up, and my total projected error is 8,850, right? Is this the happy auditor or the sad auditor? What was my tolerable misstatement? My tolerable misstatement was 15,000, so I'm thinking this auditor is what? I would say mildly happy. Okay, I'm going to kind of do this. I don't know. Maybe a little perplexed because what? I'm not happy with this many errors. I'm really not happy with that 1600 one, right? And so I'm probably starting to take another look, maybe going pull a larger sample, try and understand the control issues. I start getting into qualitative assessments at that point as well, right? From a numerical standpoint, I may be in somewhat of a safe place, but what? I'm going to be looking at the nature and the cause of those deviations. Maybe there was some intent there. Oops. Trying to highlight that. Maybe there was some intent there, right? Could be indicative of fraud, etc. So you just don't sit there and stop, just because it's a horrible misstatement and not have any other thought processes that are going to come into this discussion, right? Okay, good. So let's go ahead and let's take a look at the questions here, okay? And in statistical sampling methods, an auditor would most likely stratify a population into meaningful groups if what? Now, it's not PPS because PPS does it for me, right? So the auditor would want to do this if there were highly variable amounts in that population. Remember, we had those big ones at the top, and then all the other ones were relatively small. So we cherry picked those big ones off the top. Didn't we say that's stratification? Okay. Okay, good. How about this one? Which of the following planning factors would influence the sample size for a substantive test of details for a specific assertion? How about the expected amount of misstatement? I expect a lot of misstatement. Is that going to give me a larger sample size, smaller sample size? Larger. I don't expect that much misstatement. Larger sample size, smaller sample size? Smaller. So not only do you know that this affects sample size, you know the direction too, don't you? And you're going to make that flashcard that I asked for on that. So this is a yes for expected. How about measure of tolerable misstatement? Large measure of tolerable misstatement. Smaller sample size, larger sample size? Smaller sample size, right? $2 million tolerable misstatement, $150,000 in assets. I'm about done with that audit, right? 2-cent error, I'm going to do what? I'm going to ask for a much larger sample size. So not only do you know that these things affect sample size, you know the direction as well, don't you? So this is a yes, yes? Okay. All right, good. All right, how about this one? Let's do this one together. Okay. So they tell me in this problem that I have a sampling interval of 10,000. So I'm going to pull that 10,000 off to the side. That's my sampling interval. And then I'm going to go ahead and I'm going to start to evaluate the results of my confirmation of accounts receivable. And the recorded amount is 5. The audited amount is 4. So do I have an error here? I have an error if the recorded amount is 5 and the audited amount is 4. There's a $1,000 error there, isn't there? And just like we were just looking at in the book, I'll take that $1,000 and I will divide it by the recorded amount, which is 5,000. I have a 20% tainting there, don't I? Okay, so I take that 10,000 now times this 20%. And when I do, I project an error of $2,000, don't I? Isn't that the projected error here? 2,000? Right out of the book, right? Now, there's a more sophisticated way to do this that you would see in practice, and I think the examiners just kind of give you the baby, kindergarten, non-real world way. And you'll see a practice in this in your task-based simulation practices where they're going to be doing it this way. I'm thinking the examiners might ask you 1 or 2 questions like this. They're not going to get too hopped up on this because this is not actually how we would do it entirely in practice. There's some percentages we would put around this to make our evaluation. Okay, so this is a very basic thing here. Okay, question? All right, let's go ahead then. And let's get ourselves, we have the qualitative aspects here too, don't we? And so which one would give the auditor more concern? You found a deviation. You found a misstatement. And test of controls. So you found a deviation. Test of controls. You found a deviation. Which one's going to give you the most heartburn here of any of these? Say again, sir? D, the forged document, right? Okay, so we got to consider qualitative aspects, right? You're just not sitting here just, okay, well, I'm below this numerically, so it means that you need to consider the potential of fraud, basically, right? And other potential problems, okay? Okay, good. All right, let's go ahead and let's take a look at internal control communication now. Okay, what happens here? What do we have to do in every audit as it relates to internal control? Every engagement? Every audit engagement? Huh? Say what? Consider what? Right, we have to consider the internal controls. We have to make an assessment of risk material statement. Yeah, all the stuff you guys are saying, right? We have to obtain an understanding sufficient to evaluate the design of the control, determine it's been implemented, make an assessment of the risk and material misstatement. Based on the assessment of risk and material misstatement, if it's at the maximum, we're going to go directly to our substantive testing. If it's below the maximum, we will test the operating effectiveness of controls. We're going to put a sample of items and look at them, and that'll help us to determine the timing, extent, and nature of our substantive procedure. But we're spending a lot of time up front with the internal controls, aren't we? In that process, is there a potential that we will learn anything about these internal controls? Clearly, right? We're going to learn something about it. And what happens if we find weaknesses in the internal control? Do you think the standards would like us to communicate that to management and those charged with governance? Absolutely. In fact, they will direct us. They will say, if you find weaknesses that are bad enough, and bad enough, the specific term, significant deficiency, material weakness, you are obligated as an auditor of the financial statements to tell management about those significant deficiencies in internal control. And it could come up as part of our risk assessment procedures, could come up as part of our testing if we did that, or both, right? But we have to communicate those. Now, that's when we're doing an audit according to the Statements on Auditing Standards, SAS. We're doing that over a non-public company, right? Okay, now what happens? If we're auditing a public company, the Public Company Accounting Oversight Board rules direct us to not only do all that, but they are going to require that we give an opinion as to the effectiveness of the internal controls of that client. And really, we're going to see that the client gives their opinion on their own internal control, and we look at their opinion and see if we concur with that. But that's commonly referred to as an opinion on the internal control. So we have to not only communicate the weaknesses to management and those charged with governance, we have to write a report that can be separate or combined with our audit report on the financial statements, like we saw in Chapter 1, that calls out these weaknesses in internal control, and that's for the public to see, isn't it? Okay, so public companies, we're going to go beyond just that reporting to management and those charged with governance. We're going to have to do what? Issue a report that is read outside of the company that talks about the control weaknesses, right? And we're required to do that for public companies under SEC/PCAOB requirements, right? With me so far? So that's two scenarios we talked about here, isn't it? Okay. Scenario number 3 is going to be this. Back to the non-public company. Non-public company, we don't have to do all that, right? But there is no, prohibition against the non-public company from asking us, auditor, will you please give us an opinion on internal control? And we say, but you don't have to have one. That's okay. We want it anyway because we're in some relationship with a potential customer or business partner or something, and they've asked us for that, right? So do we have to say, sorry, you're not a public company, I can't do it? No, we say, sure. We are going to have another engagement letter now that expands to that part of the objective. And when we do that audit, do we do that audit following auditing standards? Remember we said that in audit 2, the AUs are for audits of the financial statements. We're going to turn to the ATs, the attestation standards, and we're going to follow the attestation standards if we're going to do a provide an opinion on the internal control over a non-public company. So we've got three situations under three different standards, right? The what? The non-public, where we're just auditing the financial statements under AU, there's no required internal control opinion. Second situation, non-public company, but we've been asked to do an opinion, or an optional opinion on the internal control. We'll follow what? Attestation standards. We'll still audit the financial statements, by the way, following what? Following the AU, but then we'll do what? We'll do that audit of the internal control fund, the AT. And then the third is what? Public company. Public company says when you audit the financial statements, you have to also audit the internal control. And that's clearly under what? PCAOB requirements. Okay? All right, so that's just an overview of where we're going with this. And the reason I do that is we're going to weave in and out of the discussions of those three different options. And I want you to have those three different options sort of bouncing around in your head there so that I can point to, okay, now we're under this, now we're under that. Because the way the outline is done, it's kind of hard to know if you're talking about public, non-public, and we kind of fade in and out of that. And I'll point that out to you as we go along. Okay? All right, so let's just go ahead and let's take a look and talk about internal control communication. And like I said, guys, 10 points on the exam. This is 10 points, okay? So we got to get this under our belt. So financial statement audit of non-issuers, right? And if we identify certain deficiencies during the audit, we are going to have to report those to management and those charged with governance. And notice that they're telling us that's falling under the SASs, isn't it? And I want you to put down here, no IC, what's IC? Internal control opinion. In this type of situation, we do not provide an internal control opinion. Okay? Okay, good. You come down and we talk about for issuers and non-issuers now, we could have an integrated audit where we will examine or audit the internal control for issuers, non-issuers. Okay? Now, if we are doing that and we're giving an opinion on the internal control, that is optional. So put optional IC opinion. Do we have to provide one? We don't have to. We're still auditing the financial statements under SAS, and if they want us to go further and give an opinion on the internal control, that's going to fall under the attestation standards, right? Now, if we're talking about issuers, public companies, now what? This is now required. Good, IC opinion. Now that's required, and that is covered for public companies under what? Under the PCAOB. Okay, there's our three options, right? And we're going to talk about each one of these as we go through. Now, before we do that, since we're having to report control deficiencies, I guess we better know what those are, right? Okay, and so we have control deficiency. Is a control deficiency a good thing? It's not good. It's not good. Okay, and we say control deficiency exists when the design or operation. Notice we're getting back to design, and when we say operation, we're talking about what? Either implementation or what? Operating effectiveness. So they came up with another word for that, operational, since it could be operating effectiveness, could be implementation. Okay, any of those, design, implementation, operating effectiveness, and we say does not allow management and the employees to prevent or detect a misstatement on a timely basis. Okay. Now, do they give me any sense as to the size of misstatement? Here, no sense as to the size of misstatement, so there's no indication of magnitude here. Do they tell me how likely the misstatement is? Do they say more than likely there'll be a misstatement or anything like that? So there's what? There's no indication as to likelihood. How do we spell likelihood? There's no indication as to what? Magnitude or likelihood of the misstatement. They've given me neither here. We're going to see that as we move up the food chain and these misstatements get worse, we're going to measure how bad they are in terms of what? The size of the potential misstatement and the likelihood of the potential misstatement. Okay? So you come over and you take a look at the next page, I think. Yeah. Are you getting there? Yes, you are. Okay. You can do it, little computer. Okay. So what happens? We come over and we look at material weakness. Okay. The name of this computer is Buster, by the way, if you're wondering. Okay. So we come over and we have what? We have material weakness. Okay. And material weakness, I want you to put next to that this is the worst. This is the worst situation that can happen. Okay, and we say when we deal with a material weakness, okay, it is what? Deficiency or combination deficiencies in internal control such that there is a reasonable possibility that a material misstatement will occur in the entity's financial statements and not be prevented or detected, etc. Okay, so this is the worst situation that can happen, and you notice now, have they given me a likelihood? It's what? Reasonable possibility. Isn't that my likelihood now? Have we spelled likelihood? They've given me the likelihood now? Okay. And have they given me the magnitude? Have they given me the magnitude? Have they given me the magnitude? It's a material misstatement, so they've given me the magnitude now, haven't they? Okay, so they've called out the magnitude, they've called out the likelihood, haven't they? Okay, now when we talk about likelihood, when we say reasonable possibility, means that it is what? It is getting to the stage of being probable. It's starting to get above 50%. Okay, so think about how bad this is. I mean, we're saying it's the worst situation. Think about how terribly worse this is. We're saying to you that if you hang around long enough, there will be a material misstatement in the financial statements. There'll be a misstatement that would cause you to change your decision about buying the stock of this company or something, right? This is a pretty bad indictment on their internal control, isn't it? Okay? Okay, so this is the worst situation that can happen. Now, we can also have a bad situation. So we've gone from not good to bad and then worse, and worse is worse. And you say, well, why did you describe the worst before the bad? Shouldn't have you gone not good, bad, and then worse? Yeah, but the definition of a significant deficiency leverages off of your understanding of a material weakness. So it's sort of like significant deficiencies, material weaknesses, little brother. Nobody ever remembers significant deficiencies' name. They just say, aren't you material weaknesses, little brother? Get out of here, right? And so a significant deficiency is bad, and it's not as bad as a material weakness. But it still warrants the attention of management and those charged with governance. And you say, well, why are they saying that? Well, what we're going to see is that we are not required in certain circumstances to run to management and those charged with governance about what? The not good control deficiency. But once we start getting into significant deficiencies, which are bad, and the worst situation, material weaknesses, we're going to be on the hook to report those at least to management and those charged with governance. And then when we get in for the non-public company, and then when where we're not giving an opinion on internal control, and then we start getting to the engagements where we give the opinion in internal control, either optional under the attestation standards for non-public company or required under PCA AOB, we're going to have to include these items in the report, significant deficiencies, material weaknesses. Okay, so that's why we need to know the definition of these, right? Okay, okay, good. Now you come over and you take a look, and you can, I don't know, part of me wants to say forget about this, other part of me wants to say flashcard it. So I'm on the fence because I don't know. What is a significant deficiency and what is a material weakness in the design and operation? The control is such a judgmental thing, that I'm not sure that the examiners would get too off into this. So I'll tell you what, let's do it this way. If you see a homework question where they've called out an example of significant deficiency or something, go ahead and flashcard that one. Let's do it that way so at least you have coverage of all the things that were in your questions rather than sit here and make this whole list of things that at the end of the day it's somewhat subjective. Okay, come over and let's take a look at the next page now. And we're going to get into what happens when we're dealing with non-issuers and we are simply auditing the financial statements. Matters noted during an audit of financial statements. So what standards are we following here? Try again. We're auditing the financial statements, huh? AU or the SASs. We're just auditing the financial statements of a non-public company. We're just auditing the SASs. No requirement that we give an opinion on the internal control, right? Okay, so no IC opinion. Not only is it not required, we're not going to do it in this sort of engagement. They're talking about one with non-public companies in which you are not going to issue an opinion on the internal control, right? Okay, so notice down here, not required to perform procedures to identify deficiency in internal control, nor do we express an opinion on the internal control. However, we may become aware of control deficiencies, and the requirement is not that we're going to issue a report about that for the public. We're going to do what? We're going to have a communication with management and those charged with governance. It's going to be a written communication, but it's a restricted report inside, isn't it? Okay, that we give to them. Okay. All right, so we take a look at this and take a look at the evaluation of deficiencies, and we're going to look at the magnitude and what? The likelihood, okay, of the misstatement and determine if it is a material misstatement or not. So we look at the likelihood and the what? On the next page is actually where I wanted that. We look at the likelihood and what? Magnitude to determine if that is a material, if it is a material misstatement or significant deficiency. Once we have done that, we will go ahead and have to report material weaknesses and significant deficiencies to management and those charged with governance, and they are going to give us a period of 60 days from the completion of the audit to do that. And so we come over, and if there was previously existing deficiencies and material weaknesses that have not been corrected, we have to report them again. The auditor is a broken record, and I'm getting more and more to the point where I have to explain to my classes what a broken record is by starting with a record. What a record is, it used to be this thing that you would listen to music off of, and you would put a little needle on top of it, and sometimes it would get a scratch on the record, and it would keep skipping, and it would keep repeating the thing over and over again, and rock is gone, and rock is gone, and you'd have to come and go plump until it would go over to the next thing, okay? So what happens? We're like a broken record in that we keep repeating that until it's corrected, right? Okay, we keep repeating the communication of material weaknesses, significant deficiencies until they're corrected. Okay, now again, they give us 60 days beyond the date of our report on the financial statements to go ahead and communicate these significant deficiencies and material weaknesses. They give us 60 days. Okay, so what happens? If you look at what they've told us we need to do here, it's what, who, and when. What has to be reported? Significant deficiencies, material weaknesses. To who? Management and those charged with governance. By when? 60 days from the completion of the report. Who, what, and when, right? Okay. Okay, good. Now you come over and you take a look at the next page. And let's see what the content of this written communication is going to be. So we're going to have a written communication of significant deficiencies and material weaknesses. That's the what. Who is this going to? Management and those charged with governance. By when? 60 days, right? Okay, so this is just telling us now the content of that. And so I just want you to go ahead and flashcard what that content would look like. Okay, just come down. and we will have to provide them the definition of material weakness whenever we provide this report. Even if we don't have a material weakness and we're just reporting a significant deficiency, why do we always include the definition of material weakness? Because the significant deficiency definition leverages off the definition of material weakness, right? So even if you don't have a material weakness, you still have to define material weakness so then you can explain to them what the significant deficiency is that you're reporting. If you don't have either, you're not issuing this report, right? If it's just a not good control deficiency, you don't even have to issue this report, right? Okay, good. What else goes into this? A description of the potential effects of the material misstatement, and you do not have to quantify those potential effects. Remember, we're flashcarding all of this. So in other words, you could say, well, there's a material weakness, and the potential effect is that there'll be a material misstatement in the account receivable, but you don't have to say of $10 million. You don't have to actually quantify that, right? But you do have to describe some potential effect there. So far, what? 2 items on this flashcard? Okay. Continuing the flashcard over to the next page. Okay. You have to indicate in your written communication to management and those charged with governance that you were there to express an opinion on the financial statements. Although it included a consideration of the internal control, you are not there to express an opinion on the effectiveness of the internal control, and you are therefore not expressing such an opinion, right? So that they realize this is not an opinion on the internal control. Okay? Flashcard all of those, and then give me a separate flashcard that tests that you understand that the nature of this report is restricted. This report is to who? It's not even really a report. This written communication is to who? Management and those charged with governance. It's restricted to them. Okay, good. Now, those are the required things that need to be in that communication. They also give me some optional communication items. So let's just go ahead and flashcard that. We don't have to do this, but if we want to, when we're giving the communication to management and those charged with governance about significant deficiencies and material weaknesses in internal control in connection with an audit of a non-public company under the statements on auditing standards, we're only auditing the financial statements. If we want to, we can go ahead and we can have these additional communication, which includes a description of inherent limitations of the internal control, and we can talk about the extent, nature, extent, and timing of our consideration of internal control in connection with our audit of the financial statements. Flashcard that. Things that we cannot say to them. Okay, you cannot say to them that they do not have any significant deficiencies. You can't say that because you weren't designing procedures to rule out significant deficiencies. You were simply doing what? Evaluating the internal controls sufficient to evaluate the design and controls, determine that they have been implemented, make an assessment of risk of material misstatement, and possibly test the operating effectiveness to determine the timing, extent, and nature of substantive procedure. Nowhere in there do we say search for significant deficiencies. So you can't then turn around and say they don't have them because we didn't do procedures designed to identify them, right? You can, however, call out that the significant deficiencies that you found were not rising to the level of material weakness. So if you find some significant deficiencies and you're saying they're not, obviously if you call them significant deficiencies, you're saying they're not material weaknesses, that you can communicate. Okay? So flashcard can't report the absence of significant deficiencies, can say that for the significant deficiencies you found, they are not what? They are not material weaknesses, right? Okay, good. Now you come over to the next page. That's optional communication. And this to me gets a little weird, and that the examiners ask about this gets a little annoying. I understand why the standard has this in here, but the potential that the examiners might ask this, I don't know, because this is an unusual circumstance that I'm thinking of here in which management would somehow respond to your what? Restricted communication regarding the the problems that you saw with internal control, whatever they were, significant deficiencies and material weaknesses. It's a restricted document, isn't it? Just between you and management and those charged with governance, and somehow feel that this needs to be issued in a report somewhere where they argue with you. Why do that? I mean, why bring all that to everybody's attention and then argue with the auditor, right? And say, well, okay, but the cost of correcting these will exceed the benefit of correcting them. Well, look, that's kind of weird for them to say that, but if they were to say that, the auditor would have to do what? Issue a disclaimer on that. I'm not sure why management would want to put all that in writing and get into a written argument with you when at the end of the day they can just put it in their bottom drawer or whatever, or put it up on the wall in their office, I don't care where they put it, and sit there and say, well, let's work on these, and next time the auditor comes in to do the financial statement audit, they'll be fixed, right? Okay. Okay, good. Now we come in and they give you the report. You don't have to read that report. Okay, I've given you a flashcard for the key items, but they like to include the report sometimes. But you don't need to read that. Okay, let's go over and let's take a look at integrated audits. And now what? Now we're going to be giving the IC opinion, right? Give IC opinion. Now we are going to have opinions, and we call those integrated audits because not only will we audit the financial statements, we will also audit what? We will also audit the financial statements. They want those audits to be integrated. PCAOB requires it for what? Public companies, issuers, and SASE, so it's going to be required up here. SASE, they say what? If you want to do that, we'll allow it, right? So we've got the required versus what? Versus the optional. If it's a public company, we have what? We have a required IC opinion. Why don't we just write required up there? That says required. If it's a non-public company, it is what? Optional. It's allowed. Okay, good. Now, for the most part, guys, we're going to talk about these two engagements together. There are a couple of times where we separate off and talk about them separately, and I'll point that out to you when we get to them. And we're going to see that the only thing that's causing the separation of the discussion are two issues. One is the style of the reports, and two is the issue of one is the style of the reports, and the other is the tiny timing as to the issuance of the reports. Other than that, we're going to talk about them simultaneously. So there's a small difference in timing of the reports, small difference in the style of the reports, right? Okay, so we come over, and let's first see that we're going to talk about them together, issuers and non-issuers, and we say that the objective of the engagement is to express an opinion over the effectiveness of the entity's financial reporting internal controls, right? Now, we say that when you come down, condition for the engagement, we have, again, for both of them, we must be auditing the financial statements, okay? They don't want to get into this game that used to be the case where auditors used to hire companies, I should say, used to hire a different auditor to audit the internal control versus the ones auditing the financial statements, sort of as almost a what? A counterbalance against what the financial statement auditors were finding. The standards came out and said, I don't think so. From now on, one person does both. So we've connected up the audit of the financial statements with the evaluation of the internal control, right? Okay, so it has to be done by the same auditor. Flashcard that. Okay, good. Come down and let's take a look. And this part I find interesting. Test of controls should be done. Okay, so that's important, that you have to get test of controls to provide evidence to support the opinion on internal control. This is different from when we're just doing a straight SAS audit. Do we have to test the internal controls in those engagements? Don't have to test them if we don't think they have operating effectiveness. Here, they're telling us you will test them because that's the evidence for the opinion, isn't it? Okay, so we're going to have to test those. Okay, good. Now you come down and we start talking about issuers only here. Okay, and they're talking about section 404 of Sarbanes-Oxley, which requires that in the annual report of the company, that the company provide an assessment of their own internal controls. So under section 404 of Sarbanes-Oxley, they said in the company's, and it has to be in the company's annual report, they will assess the effectiveness of their own internal controls. Okay, so that's pretty specific to public companies, because they're saying what? Section 404 of Sarbanes, and they're also saying what? They're saying that it has to be in the annual report. Okay, so what happens? We had to just talk about public companies only there because we're talking about their annual report. We're talking about a Sarbanes requirement, right? Do non-public companies have to have an annual report? Who's going to force them to if they don't want to have it, right? They don't have to have an annual report. If it's a smaller company, they probably won't have any such annual report, right? And so what happens? We've got an issue in that the non-public standards existed for a long time for these type of engagements, and then Sarbanes came out, PCAOB, I should say, came out with their requirements to implement the Sarbanes requirement, and now everybody's looking at what the AICPA's attestation standards were saying and say, man, you guys are woefully inadequate. I mean, you're not up to speed of where the PCAOB requirements are. So what did they do? They immediately issued what? Standards that would be more in line with what the PCAOB requirements were saying, right? Okay, but they can't match them word for word because sometimes non-public companies are different, aren't they? Okay, so since a non-public company doesn't have an annual report, but we want to be as close to Sarbanes as we can, we're going to create a reporting bubble in which what? We have the financial statements, we have the audit of the financial statements, and then we have management evaluating their internal control. We have the audit of the financial statements, we have the audit of internal control done by the auditor, and with that will be what? Will be management's assessment of the internal control. So they're just creating a reporting bubble over here, aren't they? But we can't say in the annual report, so that's why we have to talk about the non-public company separately, but it's still going to be the same sort of reporting bubble, which is what? The opinion on the financial statements combined with the opinion on the internal control plus what? Plus management's evaluation of internal control in a combined report, right? In the same reporting bubble, in the same document, essentially, okay? So we come over, and that's what we say on this next page. Okay, and so for non-public companies, let's see what they tell us has to happen here. And we say that we have to provide a written assertion from management, okay, this is from management, on the effectiveness of the internal control that accompanies the auditor's report. That's it. They just didn't say annual report. That's the only thing that was said different. On the previous page, it was what? Management's report that accompanies the audit report in the annual report, right? Here we can't say annual report for the non-public companies because what? Because there is no necessarily annual report for a non-public company. That's the only difference. Okay. Now you come over and we say that the auditor should withdraw from the engagement if management does not provide the written assertion, unless we're in some weird circumstance where we're not allowed to withdraw, for example, by statute or something. But for the most part, we'll withdraw if they do not provide us the assertion. Okay? So notice now, guys, we've done what down here? We've brought the public and non-public back together, haven't we? Okay? So for both public and non-public, management has to give representations to the auditor. This is the representation letter that we're going to talk about for audits here in a little while, but the representation letter for these type of engagements also has to be given. This is the management rep letter, isn't it? So who's this from? From who to who? From management to the auditor, right? So we've talked about the report. Management has to assess their internal control. They provide a report on that. It has to accompany the auditor's report, but at the same time, management has to be doing what? Handing a representation letter to the auditor, right? Okay, so we can bring those back together now for issuers and non-issuers, and management has to acknowledge their responsibility for the internal control in this representation letter to the auditor. They have to state the criteria for which they based their assessment of the internal control and their assertions on the internal control that was in their assertion report, and they're probably going to use COSO, Committee of the Sponsoring Organization of the Treadway Commission. They're going to use that crime mnemonic, although remember I pointed out what we have it out of order to spell crime, okay, the way COSO originally contemplated it, but that's probably the structure they're going to use, okay. They're going to go ahead and affirm that they did not rely on the auditor's procedures. It is not okay for management to sit back on a daybed saying, auditors, or have the auditors come and feed them grapes. Tell us when you're done with that, please. They have what? Supposedly already done the work, because whatever you say is what we say. They have done the work so that they can do give their assertions and their assessments on the internal control, right? Okay, confirm that if there are material weaknesses, significant efficiencies that they found, they've disclosed those to us. They've disclosed to us any fraud, and then they're going to have to go ahead and give us an as of date. Typically, they will go ahead and finish that around the time the auditor is going to start their work on the internal control so that we're not tripping over each other. Okay, so usually, if we're going to be starting our work, towards the end of the year, they've got theirs done in June or something. Okay, so that it's done by the time we are arriving there. Okay, again, if they do not give us this this representation letter, okay, we're going to what? Withdraw or disclaim an opinion. We have to get this. This is a required procedure. Okay. Okay, good. Now we come over and you take a look at the next page. And again, we're talking about issuers and non-issuers together. And guys, just go ahead and talk about on the next page. Just come all the way over. Okay. And on the next page, talk about this top-down approach. And when we talk about the top-down approach, we're talking about entity-level controls. This we called general level. Remember when the auditor makes the assessment and they respond at a general level, right? So we're looking at entity level controls, and just flashcard these. I used to think that this was beyond the scope of what examiners would ask, but I've learned now that they do get into it, although it be at a high level, as to the nature of entity level controls that would be considered. And these were newly released, not this last release, but a couple before this. Exam questions that cover this. So it's CPA 08. Isn't this ironic? 404. Okay, and then the other one is 08427. Okay, these are CPA exam questions that cover this question of the entity level controls. Okay, and then what? Then we will also have assertion specific level controls that we'll think about, is particularly those that are susceptible to misstatement. Okay, if they're susceptible to misstatement, what's happening with my RMM? RMM is up. Okay, so they're expecting me to think about those. So flashcard that, okay, at the disclosure assertion level. Okay, good. Come down. Testing of the controls. Yes, you will test the controls. You'll evaluate the design and what? The operating effectiveness. We're going to have to test them because they're telling us that that is the evidence to support our opinion, isn't it? So we got to test the controls. Okay, good. Now you come over, all the way over to this benchmarking consideration. Okay, and they tell us that if automated controls have not changed from the last time they were tested, we do not have to test them again. Flashcard that. What are they saying to us? Computers don't have nervous breakdowns. Okay, they don't sit there and they were doing things fine and then they get dumped by their girlfriend and now all of a sudden, they can't handle it anymore and they start screwing up, right? So we don't have to worry about retesting benchmarked automated controls if they haven't changed since the last time they were tested. Okay, now we come over and we will now form an opinion on the internal control. Okay, and so let's just take a look and see what's going to happen with management's report on the internal control. Now, when you look at this, guys, you're going to say, wait a minute, didn't we already talk about this? And the fact that we talked about, the some of these things that you're going to see here. But when we talked about those, that was in the context of the representation letter that the auditor receives from management, right? And there is similarity between the two, but this is talking specifically about what goes into management's assertion report about their internal control that everybody sees, right? You see the difference here? Okay, so come over and flashcard this, and we're going to see that management has to indicate that they're responsible for the internal control, describe that they are, looking at the internal control, identify the criteria. We said before that's the same thing they'll put in the attestation letter to us, not attestation letter, the management rep letter to us, that they use the COSA or whatever it is. You see the similarities between what's in the rep letter to us and what's in this report, this assertion letter, okay? Then what? Include a statement of the assertion about the effectiveness of internal control. We think it's effective, whatever, and gives an as of date. And if there are any material weaknesses, what were they? Okay? So flashcard these items. Come over to the next page. The auditor will evaluate that report that management provides, and if the report is inadequate, doesn't fully describe a material weakness, the auditor will correct that in their report. So our reports are going to be right next to each other, aren't they? So not only am I giving my opinion on the internal control, I'm also sort of looking at management's report and saying, well, they did not fully describe or adequately describe this particular material weakness, and we'll evaluate what they're saying as we write our report and describe those, right? So we're really, if you think about it, we're really sitting there and evaluating management's report. But to do that, we had to have done some work, and then we articulate finally what our opinion is on that, right? Okay? Okay, good. Now you come down, and they start talking about communication and management and those charged with governance. Now what's going on here? We've talked about the requirements for the external report, right? But that does not cover what we need to report internally to management and those charged with governance. We have to cover that too, don't we? Just like we did in in the financial statement audit under SAS, where there was no internal control report. We had to report some things internally. This is what this part is describing. And notice, guys, I've highlighted here that they're talking about non-issuers separately here at first, aren't they? And the reason they're doing that is because we're going to do this, we're going to talk about issuers and non-issuers separately, is there's a tiny, tiny difference in the timing. Other than that, you're going to think you're having deja vu. You're going to say, wait, didn't we already hear this? Because everything else is exactly the same. But we describe them in two separate tranches here as we go through the information. Okay? So let's go ahead and let's talk about what needs to be communicated. And again, it's a who, what, where type of approach. Communicate to management and those charged with governance in writing significant deficiencies and material weaknesses. Now, this is for non-public companies. So that was the same thing we said in an audit when we're not even giving an opinion on the internal control. We do have to communicate the significant deficiencies and material weaknesses to who? Management and those charged with governance, right? Okay, now you come down and you say, well, what's the when? The when is such communication should be made by the report release date. So they've taken away that 60-day window for the significant deficiencies, material weaknesses. Now it has to be by the date that we release our report, and in this case, obviously, it would be the report on the financial statement and the report now on internal control, right? So they've taken away the 60 days, right? Okay, now you come over, and they show us the report. You don't need to worry about what the report looks like, but just come down, and because we've already flashcarded what the contents of that report has to be. But come down, and this one we didn't see when we were auditing the public company just under the SAS standards. We're under the attestation standards now, and they add on an additional what as to what needs to be reported. They tell us that we also have to report the not good control deficiencies. So now Everything's been reported. The significant efficiencies, the material weaknesses. And they said by the report release date. Now they've added on the not good control deficiencies having to be reported, haven't they? And they give us, yes, a 60 days for the not good. Okay, they give us an add-on of the 60 days for the not good. So flashcard that. Don't flashcard that. Don't worry about that. I got a summary document that I'm going to show you in a minute. Okay? All right, so don't worry about flashcarding that. Now you come over and we take a look, and if the auditor concludes that the oversight of the internal control by management, those charged with governance, the audit committee is not sufficient, the auditor needs to communicate that. Isn't that a kind of a hard one to communicate? Because who hires and fires the auditors? Who engages the auditors? The audit committee and those charged with governance, and now all of a sudden we're going to them and saying, well, we don't think you're doing a very good job. That can get a little bit hard to communicate, right? But we have to do it. Okay, good. Now you come over and we talk about communication, audit committee, and those charged with governance if we are with a public company. So again, it's the internal communication that has to happen between the auditor and the audit committee and those charged with governance and management, I should say. And what happens? We're going to see that we talked about them separately because there's a tiny difference, an annoying difference in the timing of what gets communicated. It's still going to be the what and the who is going to be the same, but the when's going to be a little bit different. Okay? And so what happens? We come in and we say that we must communicate in writing to management and the audit committee all material weaknesses. So that's the what and the who is the same. But they tell us now that those communications are to happen when? Prior to the issuance of the report. For the non-public companies, we said for the material weaknesses, it has to happen when? By the issuance of the report. So tiny timing difference. Here it's prior, before it was by the issuance of the report. That's the only reason we separated the conversation is the timing of these, right? Okay. You come down and they say the auditor is required to communicate any significant deficiencies in writing to management and the audit committee. We said that for the public companies as well. We said what? Have to report material weaknesses and significant deficiencies, and it has to be by the report release date. When we get to the public companies, for material weaknesses, they say prior. And for significant deficiencies, they don't specify a time. There's no time specified there. When we were looking at the non-public companies, they said by the report release date, didn't they? Here, they're not calling out a time. Okay, so there's no time specified here. Okay? No time specified. No time specified. Now, when we get over to reporting the not good control deficiencies, we said what? We said that needs to go to management, and we have to inform those charged with governance know that such communication has been made. In other words, we don't have to give the detail of the not good control deficiencies of those charged with governance, but we at least have to let them know that we've reported that over to management. So if they want to tap management and say, we want to see those too, they can, right? Right? Okay. Now, we said that same thing for the public companies, but these are the public companies, for the non-public companies, but what? But here, they haven't specified that 60-day window like they did for the non-public companies. Remember, for non-public companies, they said what? For the not good control deficiency, has to go to management, have to know those charged with governance, know that such communication has been made, and they gave us a 60-day window for that. Right? That's under what? That's under the attestation standard. We're giving the opinion on the internal control. Right? Under the SAS, do we have to report these at all? Not good control deficiencies? Under SAS, we don't even have to report them, right? Under the attestation standards, they tell us we have to report them to management, the not good control deficiencies, and let those charged with governance know that such communication has been made. Under the what? Under the attestation standards, they gave us 60 days. Under the PCAOB requirements for this, they are not specifying a time. So again, no time specified. Okay, so if you look at it, the only difference is the time, isn't it? The only difference is the time? Okay. Okay, good. So let's go over and take a look at number 4 here. And if the auditor concludes that the oversight of the audit committee, those charged with governance, is not sufficient, we need to tell them about that. Is that giving you deja vu? Same thing we said for what? For the non-public companies, right? We have to let them know. Same exact thing we said if we don't think they're doing a good job. And that's not easy. Okay. Okay, now you go over and you take a look at the next page and we start to talk about the reporting structure, and we talk about non-issuers separately here from issuers because it turns out that there is a slight difference in the way we can issue this report. Okay, we can either issue the report directly on the internal control, or we can issue the report on management's assertion about the internal control. So we can sit here and we can say, we have examined the internal control. And so we're issuing our report in that option directly on the internal control, right? Right? Go over to the next page. We could issue the report on management's assertion. And in that case, we will say we have examined what? Management's assertion. So we have an option as to the reporting, either directly on internal control, or we're going to say what? We have looked at management's assertion. That option of reporting, those two options, are only available for the non-public companies. We're going to see in a minute for the public companies, you have to report directly on the internal control. That's the only option you have. So that doesn't even make it an option. You're required to do what? You're required to do the one where you report directly. We'll get to that here in a second. That's the only reason we have separated these. Now, when the public companies versus non-public company discussion. Now, when you come over, you take a look and you should flashcard that the examiners for our non-public company report like to ask about this inherent limitations paragraph that you see up here, okay? And all this thing does is basically say, even if I'm giving you an opinion on the internal control, and that opinion is an unmodified opinion on the internal control, there's still a chance that stuff will happen, bad things will happen. So you're just basically saying stuff happens here, okay? That inherent limitations paragraph tends to be there. Okay, now you come over and you take a look, and when we issue these reports, we can issue them either in a separate or a combined report with our report on the financial statements. Okay, we can either issue them combined or separate with our report on the financial statements. If we sit there and issue separate reports, they need to point to each other. So the report on the financial statements, the opinion on the financial statements will point to the opinion on the internal control. The opinion on internal control will point to the opinion on the financial statements if they're separate. So we can do them combined or separate. If you guys want to end this, I mean, I don't need to sit here and talk. I know all this stuff already. We can call it off. I mean, it's not like I have to sit here and go through every single one of these. You want to stop now or you want to keep going? Okay, just checking. Okay, so let's come over and let's take a look at the next page and come down. And if we find a material weakness in the internal control, and just come all the way over, I guess, to the next page. All the way over. You don't have to read through that whole report. Come all the way over and down to, I guess, the next page, okay? And if we find a material weakness, all the way over to page 43, if we find a material weakness in the internal control, and this is one, it just takes one material weakness, what type of report do we issue? Adverse opinion. It only takes one, okay? So go ahead and put here that we will never qualify. There's no such thing as a qualified opinion. It's not like, well, you had one, so we'll give you a qualified, but if you get two, we're going to give you an adverse. How many does it take? 1 to result in an adverse opinion. Okay? Okay, come down, and if management's report fails to include a material weakness, we will call that out in our report and we will include it. Okay? If management's report includes a material weakness but does not adequately describe it, we will include that in our report. Okay, so remember, we're always looking back at management report to see if it's okay. Note that if we have a material weakness, we will have to report now directly. They take away the option of reporting just on the internal control. Okay, so on management's assertion. So if we have the material weakness, we will have to do what? Report directly, right here. Might help if I show you what I'm talking about here, and I want you to flashcard that. So if we're sitting here and we find the one material weakness, now we have to do what? Report directly. In other words, they take away the option of reporting on management's assertion. Okay? Okay, now we come down and we talk about reporting on the internal control now for issuers. Okay, and hear me on this now. The only difference is they take away the option of reporting on the assertion. That's the only difference. Now they're telling us we must report what? Directly on the internal control. So under the PCAOB requirements for non-public companies, we don't have two options. We only have the one option, which is what? Report directly. There is no reporting on the assertion like you have under the attestation standards. That's the only difference. Okay? Everything else is going to be the same. How many options for non-public companies? Two options for non-public companies, either report on the assertion or report directly, unless there's a material weakness, in which time they tell us we have to report directly, right? When we're dealing with the public companies, we only report directly. Other than that, everything else I said is going to be the same about what goes into those reports, okay? So let's just go ahead, though, and let's look at it anyway. And they say that we can have them in what? In two separate reports or a combined report. So we can combine it with the report on the financial statements or the reports. So we'll combine the two, or we're going to have to do what? Issue a report on the financial statements separate from a report on the internal control. Okay? Even if you separate them, the two reports need to point to each other, don't they? So go all the way to the top of page 45. If it is what? Two separate reports, the reports have to refer to each other, which is the same thing we said for the non-public companies, right? Separate or combined. If the reports are separate, they have to point to each other. Okay, come down here to number 3. If you have a material weakness, how many does it take? 1. Just take 1. We give what type of opinion? Adverse opinion. That's exactly the same that we said for the public companies. Non-public. We are talking about public now. If management reports fails to include one or more of the material weaknesses, the auditor will include it in their report. Same thing we said, right? Okay. If management includes the material weakness, but they don't do a sufficient job describing it, we will correct that in our report and describe it. Same thing we said for the non-public, isn't it? Okay. Come over to the next page, all the way down, and we start talking about scope limitations. And notice we've brought them both back together now. So it's issuers and non-issuers, right? We're back together now. So the only thing that changed, guys, in that last section is what? The combined, the direct versus what? Versus reporting on the assertion, right? Other than that, it was the same exact thing. Okay? All right. Now, when we talk about scope limitations, we bring them back together because there is no difference. And if there is some part of the engagement that we cannot complete, we withdraw from that engagement. You never qualify. You don't qualify because you found, only one material weakness. We said that we go directly to adverse. You don't qualify for a scope limitation, right? So that you never qualify. It's either going to be I was able to complete everything, or it's going to be that I do what? That I withdraw from the engagement. There is no, or I disclaim an opinion, but there is no what? There is no qualifying. Never qualify. Okay? Okay, good. You come over and you take a look at the next page, item C, and we say any material weakness identified should be described, and the definition of material weakness should be included. Flashcard that. In other words, even if I'm disclaiming an opinion from the internal control, that doesn't mean that I'm not obligated to report out the material weaknesses that I've identified, right? So I still need to do that. Okay? Okay, good. Come over and let's take a look all the way over at some questions, and now it's going to catch up with me. Okay, let's try that again. Okay, so let's just go ahead and let's take a look at some of the questions now, class question 9 for this. And with these questions, the trick is to sit there and first know what type of engagement you're on. Are you dealing with what? A SAS audit where you're not giving the opinion on internal control? Are you dealing with a what? Attestation engagement for a non-public company where you're giving the opinion on your option, or are you what? Are you under the PCAOB requirements where you're required to, right? That's always the first step when you're looking at a question that's asking about internal control communication. And so we say auditor letter issued on significant efficiencies related to non-issuer. So we're either under SAS or the attestation standards, right? And so it's communications on internal control observed during an audit of financial statements. What standards are we under? This is SAS. Good. Okay, so with that, let's look at the choices now. Include a brief description of the tested controls. No, we just issued the opinion on the financial statements, and we're not even required to test the controls, right? So that's nonsense. How about indicate that the significant deficiencies should be disclosed in the annual report? That's what? Nonsense. We don't even have an annual report, right? How about include a paragraph describing management's assertion concerning the effectiveness of internal control? Really? Show me where in anything we've talked about under the SASs where management has an assertion concerning the effectiveness of internal control. Have we ever said that management has to give an assertion about the effectiveness of internal control? Okay, so that's clearly not it. Not under a SAS audit. Indicate the auditor's purpose was to report on the financial statements and not to provide an opinion on the internal control. Well, obviously that's the right answer, and we included that on our flashcard of what's included in the communication, so they know we're not there to give an opinion on the internal control, right? Okay. Okay, good. Come over. Let's take a look at the next page here. Next question. And reporting a non-issues internal control over financial reporting and an attest engagement. Well, thank you, God. They've told me what? They were under the attestation standards. They just came right out and told me. Okay. So what should we include in a paragraph describing documentary evidence regarding the control environment factors? What, are we trying to put them to sleep? No, we're not going to get into that. Changes in internal control since the prior report? Huh? No, we didn't get into that. Potential benefits from the practice. We don't want to put the readers to sleep now. We don't want them to go into a coma while we're reading this, right? Okay, while we're writing this. How about potential benefits from the petitioner's suggested improvements? Hardy har har. If we would even get involved in that, we certainly wouldn't put it in this report. And so we said that what? We do have that inherent limitations paragraph. Stuff happens paragraph. Okay. Okay, good. Come over and let's take a look at this question. Now this question is interesting to me because, oh, darn it, I forgot. I forgot this thing. Can I make this bigger? I have this thing. I don't know if it's going to cooperate with me. On Google. And what this thing does, because I went through a bunch of the things that were in the book that I didn't ask you for flashcards for, because you would have just been making flashcard after flashcard of this, and kind of put them here. And if you look at the rows, The rows here are going to be the different types of engagements. So we have what? Non-public company, where we're just doing a SAS engagement. We have what? Non-public company, where we're doing an attestation engagement. Public company here at the bottom, where we're doing a requirement for the opinion on internal control under PCAOB. And then across the top, I asked some key things that I think might be questions that they could ask you on the exam. Oral communication is never okay. We are going to get a written report is required on all engagements, and it's no for under SAS. It's only if we have what? Significant deficiencies and material weaknesses, right? Under the other two, we always have to provide the written report. That's the whole objective of the engagement, isn't it? On the internal control. Okay. What must be reported? Remember I said it's what, who, and when. Significant deficiencies, material weaknesses, okay? You guys can read this because I don't want to, people are starting to put their head in their lap and I don't want to deal with it, okay? So just read that, okay? And just go ahead and I don't want to sit here and try to teach a class when people are watching their clock and, I got better things to do. It's Saturday afternoon for me too. Okay, so let's just go ahead and let's take a look at this question. And the objective when you're doing a question like this is to sit there, not the objective, but the first step is to sit there and make sure that what engagement, what type of engagement you're under, what standard you're under. And you take a look, and they do that for us here in this Becker question. And by the way, my point of going back to that thing is that this is similar to this, where I've given you the rows up here of the columns up here of the significant things, and then the rows of the different standards, which is the way this question was set up. And so I think this question was created by someone in Becker, but they kind of looked at it the same way I did. Here's some of the key reporting elements, and you need to know how they work by engagement. Okay, so you come over, and we take a look, and we say that Joanna, CPA, is auditing the financial statements of a publicly held company. That means we're dealing with what standards here? PCAOB. Okay, good. And then James, CPA, is auditing the financial statements of Perfect Papers, a privately held company. Well, since it's just the financial statements, right? It's non-public company. That's going to be SAS, right? Okay. And here they come out and they tell me that we're auditing the internal control of a privately held company. Well, that's going to be attestation standards, and we have to audit the financial statements following what? Following SAS, don't we? So we're also doing SAS. We have to have some standards to audit the financial statements, so that includes the SAS requirements. Okay, good. Now you come over. Management representation should be obtained. And the answer here is all three, although under the SAS audit, the representation is probably going to be what? Limited to just the representation about the financial statements, but we still get representation, right? When you go into PCAOB and the attestation standards, we talked about the nature of the representations from management to the auditor, right? And we went through that. So you still have them in all three engagements. E, material weakness will result in a qualified or adverse opinion. Is that true? One material weakness we always give adverse, and we're not even giving an opinion under SAS, right? Right? Okay. F, a material weakness will result in an adverse opinion. Well, that's true if we are under what? Under the PCAOB and the attestation requirements. There is no opinion on the financial statements under SAS, right? Oh, okay. Not two? That's the SAS one? Okay. I don't know why they couldn't have put them in order. Start with SAS, then the attestation, then PCAOB. But anyway. Okay. Okay, good. How about G? The auditor is required to communicate significant deficiencies and material weaknesses in writing to management and those charged with governance. All three, right? Now, that's what will generate the communication under SAS, but you still have to communicate when you have it, right? Okay. Okay, good. The report on internal control is restricted as to use. Huh? That's only required under SAS. Look, Why call somebody in to do an audit of your internal control and issue an opinion on it to show it to yourself? Obviously, what? You have determined that you want that to share it with others, right? Okay. Okay, good. All right, so let's go ahead and let's wrap this thing up now, talking about the communication with those charged with governance. Okay, and you're saying, but John, we already talked about communication with those charged with governance because we talked about the internal control, but there are other communications with management and those charged with governance that we want to think about here before we get out. Okay, so just come over and let's look at the required communications. Okay, and when we deal with the required communications, it's going to be matters related to the audit, such as the auditor's responsibility, such as management's responsibility. Now, how do we communicate that? We communicate that in the engagement letter, don't we? So we're kind of going all the way back to the beginning here now and talking about things that we already understood have to be communicated through the engagement letter, and I gave you flashcard for that, right? So that's engagement letter type stuff. Okay, come over to the next page. Overview of the plan scope and timing of the audit. That is engagement letter stuff, right? There it is, engagement letter. I never realized they said that right there. That's also the engagement letter, and we've talked about that, haven't we? Okay, so then what must be interesting here are what are the findings. Now we're getting to the stage where we're about done with the audit and we want to see what has to be communicated in terms of findings. Okay, so let's just go ahead and take a look over here, and this is really a management report card. What is our view regarding the appropriateness of the accounting policies, the appropriateness of any significant accounting estimates, management's judgment, the adequacy of the financial statements, significant difficulties encountered during the audit, were they cooperative, etc., disagreements with management, and if there are uncorrected misstatements, what are they? What is their impact, etc.? So this is sort of a management report card, isn't it? Okay, continue on to the next page, finish off that flashcard. Material uncorrected misstatements should be identified individually, and the auditor should request the correction, obviously, of what? Material misstatements. Okay? Okay, good. If there are circumstances that impair our independence, we report that. If there were material misstatements, those have been corrected, etc. Now you come down and we say if those charged with governance are not involved in managing the entity. You could have someone sitting on the board of directors that sees the finished product, the audited financial statements, and thinks to themselves, well, this must have all been perfect. Meanwhile, you had to do what? You had to go through all kinds of adjustments, etc., to get there. So you want to make sure that those charged with governance understand that process. And so material corrected misstatements, management representation requested by the auditor, and if management consulted with other accountants and you're aware of that, that should be communicated as well. Okay, so you come down and they tell us that communication with certain matters that would go to those charged with governance may not be appropriate for management to hear. Okay, for example, maybe you think management's inadequate or something, right? And so you maybe want to take that directly. So when you're looking at questions like this, the thing to remember is everything goes up to the board of directors. Not everything comes down to management, right? Okay. All right, good. Now you come up over and let's go ahead and flashcard that the form of communication could be oral or written, because that's one of the things the examiners like to focus on is see if you know that these communications can be oral. They do not have to be written. Okay, all right, good. Come all the way over and let's look at finally the management representation letter. Okay, we have to get this at the conclusion of field work. It is the last piece of audit evidence that we get. Going over to the next page, okay, contents of the management rep letter, and there is the obligatory Management's responsible for the fair presentation, the financial statements, the internal control, the compliance with laws, etc. When you start getting down here, we start talking about things that are hard to audit. We put these things in here because if they're hard to audit, we want management to sign off on that they've told us about these things and they've helped us with these things. Starting with completeness. Okay, completeness is something that is hard to audit because what? Of all the assertions, it's the tougher one because if this bottle is the financial statements and the whole world is everything that potentially needs to be included in here, it gets hard to make sure that everything got into this little bottle, doesn't it? So what do? We make sure that management does what? Management puts down that they've given us complete information. That's covering us, right? We want this last piece of document we get to cover us for things that might be a little tricky for us, right? Notice we don't mention existence here because existence, we should be able to say, okay, they say that's there. We go and we find it, right? Okay, but for completeness, that's a little harder, and so we ask them to give us something in the report. Continue on. Is fraud hard to find? So we ask them, hey, you have put in, and when we say acknowledge their responsibility for implementation, design, implementate internal controls to prevent and detect fraud. Notice, guys, we're looking for programs from them. We do not expect that management will put in the rep letter that they will detect fraud or prevent fraud because nobody can say that, right? Okay, but so they're looking at the internal controls, though. They do have to put that in there. Okay, if there has been fraud, it's been disclosed to the auditor. This is hard to audit stuff, isn't it? That we're looking for them to help us with. They should know the laws and regulations that they're under, and if there have been non-compliance, they've told us about it. Uncorrected misstatements. If there's something that's uncorrected, it's immaterial, and obviously if it's material and they know about it, they've disclosed it to us. Litigation claim and assessments, right? We talk to the client's attorney, but remember the client's attorney could leave certain confidentiality items out of there, so we ask management to be upfront with us about those things, right? And put that into the management rep letter. Okay, estimates that they've made. They believe that they are reasonable. Related party transactions were things that were hard to audit. Remember how upset we said we would get if there was a related party and they didn't tell us who it was? Okay, so this is really what? Subsequent events. Remember we said the problem with subsequent events is the world keeps going and it won't stop when we're trying to issue the financial statements. So all of these things are things that are a little bit squishy for us, sort of like moving around on us, and we do what? We try to pin it down by making management put in the rep letter that they've helped us and told us about these things. Okay? All right, so that's it. Let's go ahead, though. Since we're a little bit over now anyway, we might as well keep going here. And let's finish up at least these multiple choice questions. Okay? Okay, so let's take a look. Which of the following statements is correct about an auditor's required communication with those charged with governance? Assume that those charged with governance are not involved in management of the entity. Does everything have to go up to them? Everything has to go up. So let's take a look. Any matters communicated to those charged with governance are required to be communicated to the entity's management. That's not correct. Everything goes up, not down, right? The auditor is required to inform those charged with governance about significant errors discovered by the auditor and subsequently corrected by management. Yes, if they're not involved in the day-to-day, we expect them to know the issues that happened during the audit that led to the eventual potential unmodified opinion, right? Okay, good. Take a look at B here. Disagreements with management about the application of accounting principles that are not required to be communicated to those charged with governance if they have been appropriately resolved. No. We want them to know about the fun that we had on this, right, in completing this audit. Significant efficiencies in internal control previously reported to those charged with governance that have not been corrected need not be communicated again. Well, that's from the last section, but what? No, we're a broken record. We report everything, don't we? And we repeat it, I should say, if they haven't been corrected. Okay, which of the following matters would an auditor most likely include in a management representation letter? Now, there is a slight problem with this question, which is what? Who
Or does
ish?
the representation letter?
Management writes the representation letter, not the auditor, right? But this is probably an experienced auditor who has been on engagement in which you do what? You say, please give me your letterhead to management, and you print out the management rep letter on that and say, please review this and sign this, because you know what you want in there, don't you? So, so it's a little bit, the person is right. You ask them to sign. And depending on the management, I was on an audit one time where the person said, I'll resign before I sign this. And I'm like, well, don't resign until you know what you're resigning over here. I'm just telling you, this is what this is saying, So you have some people that are inexperienced. Others, they know the routine. Yeah, give it to me. They may sign it themselves. They may say, have the council look at it, make sure there's nothing weird in there, and then they'll sign it, right? Okay, so, but anyway, assuming that, we're asking what should be included in the management rep letter, take a look. And item A, communication with those charged with governance concerning weakness in internal control. Why would management put that in a letter to the auditor? Again, the auditor is not writing this letter. Who communicates the weaknesses to management? The auditor communicates the weaknesses to management, not management, to those charged with governance, not management reporting it to the board of directors, right? So that doesn't go in the rep letter. This is from management to the what? To the auditor, right? Okay, so conversations between management and those charged with governance are not included in there. Reasonableness of significant assumptions used in making accounting estimates. That sounds reasonable, but let's see. C, plans to acquire or merge with other entities in a subsequent year. No, okay. We thought about in 10 years we're going to do this. No, this is ridiculous, right? How about D, management acknowledgments for responsibility for detecting employee fraud. That's too much. They can say that they're responsible for the internal control to detect it, but they're not going to say they're responsible for detecting, right? So now you go back up in what? The reasonableness of the assumption is something that would be included, right? Okay. Okay. Question? Okay. Couple of, yes, sir. Yeah, we can in a second. Couple things. I'm going to go ahead and pause. I want to stop this or pause. I'm going to